This session is being recorded, so anyone who comes along later will be able to watch it, and this course will be available for a full year. So anyone who wants to take this class can do so and watch the same lecture you're about to watch because it is being recorded. And you have a large reading assignment at the front. I don't expect you guys to read it, but if you want to know where information in the manual came from, most of the information in the manual references the documents listed on the front. So we're going to move past that and on to page 2 of the manual where we have an introduction. And the big thing about 2011 is, quite frankly, it wasn't a very exciting year in terms of new stuff. And when you think about it, 2010 wasn't that exciting in terms of new stuff. It was just that stuff that was supposed to expire unexpired. So we had the basic major Bush cuts that were enacted in 2001 gave tax breaks to large segments of the population. Pretty much everyone got a break of some kind. And you may recall the politics going on at the time about whether or not the Bush tax cuts were affordable. And as we got into 2008, they were all set to expire at the end of 2010 for the most part. So in 2008, there was legislation going on to try and extend some of them, and it was finally actually at the 11th hour in December of 2010 that many of the Bush tax cuts were extended. Some of the Bush tax cuts were extended through 2011, and some of them were extended through 2012. So it may be the case that some of the items that we talk about today are things that you're going to say, oh, I've known that for a long time, that's not new. Well, what's new is we're either in the last year with 2011 or 2012 will be the last year. But at the same time, we have lots of tax stuff that did happen in 2010 that was unique, new types of laws. But most of those were directed at small business. So we're going to be talking about a lot of different topics in today's class. We're going to focus quite a bit on some of the business tax breaks, but we're also going to look at many of the tax impact situations for individuals. Some of the information I give you in today's class is going to be new to you, and some of it is going to be a refresher of things we've already known. Now, I could pretty much summarize what's changed in tax law for 2011 in about an hour. But I feel that to give people a good start to the tax season, it's important to do a really good refresher on some of the more important things that we deal with on a daily basis with our clients. So you're going to find that I'm going to do a lot more in today's class than just talk about what's new. We're also going to talk about a lot of things that maybe you didn't know, or maybe they're customer service issues that you'll be thankful that you've learned today, because these are the reasons our clients come to see us. Yes, they want to know what the latest tax law changes are, and they want to know that we know what they are, but they also want to know what to do if they owe. They want to know what to do if their refund's been garnished. They want to know stuff like that, and they expect their tax professionals to be able to help them with that. So that's just to kind of give you an overall introduction to what we're going to talk about. And for the most of today, I'm actually going to be reading from the manual. That's just my style. And we're now at the top of the second page where we have the introduction. And in this introduction, I show you the major pieces of legislation that were signed into tax law in 2010. And they include the Hiring Incentives to Restore Employment, or HIRE Act, the Patient Protection and Affordable Care Act, the Healthcare and Education Reconciliation Act, the Homebuyer Assistance and Improvement Act, the Small Business Job Act, and the Reed-McConnell Tax Relief, Unemployment Insurance Reauthorization and Job Creation Act of 2010. So I might just say Reed-McConnell Act to keep that short from this point forward. Now, by comparison, 2011 was a relatively quiet year in tax legislation. However, the IRS has updated and changed tax forms and is implementing a variety of regulatory changes that impact paid tax preparers in the 2011 filing season and, of course, into the 2012 filing season. So this course covers many of the temporary 2010 tax law changes that affect 2011 returns. It also covers some of the existing laws that have become a focal point of IRS enforcement. So maybe the law isn't new, but the attention the IRS is giving to it is new. So maybe in the past you didn't need to worry about it so much because no one was paying attention. Well, now they're paying attention, so you need to as well. And of course, we're going to cover some of the more important regulatory changes that are impacting tax preparers in 2012, namely the new registered tax preparer laws. So by the end of today's class, you should be familiar with the 2010 legislative changes. You should also be aware of some important changes to a variety of the 2011 tax forms, some of the areas of enforcement that are the scrutiny of IRS, regulatory changes that are affecting paid preparers for 2011 and future years, certain ethics and electronic filing issues that also affect paid tax preparers, and what else I thought was important that maybe I'd tell you about. Another thing to comment on is that Pacific Northwest Tax School, our style or our focus of teaching is in many ways very different than what you'll encounter in other places. The first thing you'll see is that I give a very detailed manual. And the purpose of the manual is to really summarize what I see as a tax professional as being really relevant to our work as tax preparers. And I do my very best of taking tax law as we see it written in IRS publications and pulling out what I think is most relevant, sometimes rewording it, sometimes keeping the same wording, in an effort to make sure I'm giving you what is the most relevant and most accurate information I can. The other side of what we do is tax return mechanics, and that's looking at the tax form itself, how it's put together, and how numbers are put on that form. And of course, filling out forms is what we do for a living, isn't it? So I've always felt that the mechanics of tax forms is actually the most important part of tax education. Now I know the law over here, and I have this computer software program here, and now what? The computer asks me for information, and I put it in, and then it gives me an answer. But if I don't understand tax law well enough, and I don't understand form mechanics well enough, how do I know if I got the right answer on my software? So I want all of my staff and myself to be able to look at a tax return finished in tax software and be able to understand every single number on every single line, why it's there and where it came from. And if it's wrong, why it's wrong, to go back and fix it. So we do communicate as much of that as possible in our classes. So let's move on now to page 3. And on page 3, I've started with a picture of our new 1040. I don't know about you, but when I see the new 1040 form each year, I get excited. Ooh, what's changed? Well, it's got an 11 instead of a 10. That's the first change. The next change, I thought this was rather interesting. The IRS has clarified the information in the presidential election campaign box. Now it states that there is enough information in the box to tell the client that it's not going to affect their tax if they check the box. So we've had the box for a few years where that you just check it or you don't check it, and a lot of people think that if they check the box it's going to cost them money. But that's not the case, and the form now contains more information to help clarify that. Also, there's a new address line for foreign addresses. I thought that was rather interesting. Moving over to page 2 of the form, you may recall that the 2010 form was missing the standard deduction amounts, and that was rather inconvenient. I make a habit of memorizing as few numbers as possible, and the lack of numbers on the back of page 2 was rather irritating since 2010 was the only year they'd ever been missing. Anyway, they're back. Yay. Moving down to other taxes, you'll see on line 50, actually it's 59, we have line 59A, line 59B, and these two lines reflect Schedule H for household employee tax and also the repayment of the first-time home buyer credit. Advanced EIC, which has been on that line for many years, is gone. There is no more advanced EIC as of 2011. We also have a line that has been added, line 60, and this is a dedicated line for listing other taxes. In the past, if there was an additional tax that needed to be added, you basically typed it on the dotted line. There was no line for it, so you just were supposed to type it on the dotted line, and you may or may not have noticed that tax software would do that. Now there is a dedicated line for the other types of taxes that may be imposed on a filer, and also a system of coding those taxes so the IRS knows what tax you're putting on the line. And then, of course, down in the payments section, the making work pay credit line has disappeared. because we no longer have a making work pay credit. And that's the summary of what's new and different. Now, the format of today's class is, well, I like to look at the 1040 and take it line by line. And of course, one of the very first lines on the 1040 is where we enter our exemptions and claim dependents. And then after that, oh, there's a wage line, and then there's an interest line, and then there's a capital gain line, and so on. And so today's class is going to go in that order, the order of the 1040 form. I don't have an index or a table of contents for my manual. I never seem to have enough time to actually do one. But if you're looking for a particular subject matter, one of the easiest ways to find it is just to say, okay, what line is that on of the 1040 form? And it's going to fall in that space of the manual. So that's April's backdoor table of contents. All right, so beginning with line 6D, this is not a new law, but it's an important law, and particularly when it comes to electronic filing and habits that tax preparers have engaged in for many years, myself included, I feel it's really important to bring this up and remind you about it. Beginning with 2009, the non-custodial parent in a divorce situation or a separation situation can no longer attach pages from the divorce decree or separation agreement instead of Form 8332. What this is saying is if your divorce went into effect before 2009, it is acceptable to attach pages from the divorce decree to show you're entitled to claim your child's dependency exemption. From 2009 forward, that is no longer acceptable. So what that means is Form 8332 has to be signed, or some other separate statement has to be signed, and it has to be attached to the tax return. The non-custodial parent must attach 8332 or that similar statement that is signed by the custodial parent. And the signed statement must have the sole purpose of releasing a claim to that child's exemption, and the non-custodial parent must attach the required information even if it was filed with a return in an earlier year. There's also a clause on Form 8332 that was added for 2009 and later years that allows a parent who revoked a child's claim to an exemption or revoked their claim to their child's exemption to unrevoke it, to take back that revocation. And there's procedures in place about when the revocation can be done. And the IRS has stated that if you revoke a claim to an exemption for a child that you had released, then you cannot enforce that revocation earlier than the year after the year you revoke it. So what that means is if I revoked my child's exemption claim to my ex-spouse for 2010, I can't come along later in 2011 and change my mind and get it back. In fact, the latest I could give up that claim to that child's exemption would be 2009. So in 2011, if I change my mind and say, oh, ex-spouse, I'm not going to let you claim my child for 2011, that's too late. I could make a revocation in 2011 that will affect 2012. So those rules are spelled out on the 8332. Moving over to the next page, page 6, you'll see a copy of Form 8332. There's an interesting thing about this form. I used it for many years, even in situations where parents had never been married, because I would have a man and a woman who had a child together. They were never married, and there would be a discussion about who could claim the child, even in situations where they didn't live together. So what would happen is I would say, well, let's just settle things and have you sign this form. And one year, a lady pointed out to me, it says, do not use this form if you were never married. And I thought, well, sign it anyway. Well, now the IRS actually has an instruction on it that says use the form even if you were never married. So apparently people like me thought it was safe to use it, and the IRS is saying not only is it safe to use it, we want you to use it. Now what do you do when you're e-filing? Because of course as electronic filing originators, tax preparers are supposed to be working as EROs and transmitting tax returns electronically. The 8332 is a paper document. How do you e-file it? The rules are that the custodial parent has to sign the form, and the non-custodial parent needs to attach it to the tax return. So how do you do that on an electronic return? Well, the answer is that you attach it to Form 8453. So the non-custodial parent will file electronically claiming an exemption for the child. the tax preparer, at the time they file that tax return electronically, should have the signed 8332 in their grubby little paws. You've got it in your hand. Okay? Now what do you do with it? Well, you attach it to Form 8453, and within 3 days of IRS acceptance of the electronic tax return, Form 8453 is mailed into the IRS with the 8332 attached. This is probably new to a lot of you. And so I have up in front of you now the box that you actually check on Form 8453. Now, some of you may have been in taxes as long as I have. I'm in my 20th year this year. And there was a time when the only form we dealt with in electronic filing was Form 8453, and we always mailed it in. And then the IRS moved over to another form for signature collection that was not mailed in, 8879. Yeah, so the 8879 form is a form we have our clients sign, but we keep it in our file and we don't mail it in. And it replaced, for the most part, 8453, which used to get signed and mailed in. Well, actually, 8453 never went away. It is still a form that gets mailed in. It's just that it is only mailed in to accompany documents that cannot go out electronically. And one of the most important documents you should be aware of is Form 8332, because how often in the tax season do we have non-custodial parents trying to claim a check? All the time. So this should be a form that you have, you know. And if you're filing a tax return electronically for a non-custodial parent claiming a child's exemption and this form isn't attached, that would be a problem because the law requires that you attach it. Right, moving on to the next line of Form 1040, on to the W-2. For taxable years beginning after January 1, 2011, a new section 6051, requires employers to report the aggregate cost of health insurance premiums on Form W-2. Interim relief is offered for tax years 2011 and 2012. Which means penalties will not be assessed upon employers who fail to include the cost of premiums on their W-2s for these years. So what's happened is the law says the employer needs to put the cost of health insurance paid for employee on the W-2. And it goes in box 12 with the code DD. Now, it could be that you're going to have all kinds of W-2s coming through your offices this year that have this code DD with a big number next to it, because health insurance is, well, very expensive. And there's two purposes to this. The first purpose is the federal government decided it wanted employees to know how much their employers are paying for their health insurance. The second part of it is that in 2018, a tax will come in to tax high luxury health insurance plans, these gourmet plans that pay for everything and cost $20,000 a year or more. Those types of health insurance plans may be subject to a tax beginning in 2018, but it's a tax on the employer for giving this really big, robust plan far in excess of what the common people get. So it's nothing that's impacting people today. It is not meaning that the health insurance being reported on the W-2 is being taxed, because that is not the case. But there is a potential in future years for people who have absurdly expensive health insurance that the employer who gives them that extraordinary, unusual benefit will have to pay a tax for giving so much. And let's move on to line 8 now. Line 8, there's nothing new about line 8 this year, but the IRS attention being given to interest, dividend, and capital gain income is really high now. And so we're going to talk about what it is that they're doing to ensure that people are reporting their interest, dividend, and capital gain income, particularly income from overseas investments. So as you might well be aware, there's certain people out there who have money overseas, and well, they think that they shouldn't have to pay tax on it to the American Treasury. And the IRS has spent many years, actually our federal government has spent many years trying to figure out what to do about this, how to close that tax gap and get people who are not reporting their foreign income to start reporting it. As tax preparers, we need to understand that the IRS is looking for this income and actually has the ability to find it now. That our federal government has made agreements with other foreign countries to share information with their banks. So if you happen to have that hidden bank account in Switzerland, it may not be so hidden anymore, but the IRS can find it. So we're going to talk a little bit about what we as tax practitioners need to know about the reporting of these overseas accounts and the rules that relate to those. So beginning in 2011, there are 2 reporting requirements for individuals who hold control over foreign bank accounts or investment accounts. Individuals with more than $10,000 in foreign accounts must file Form TD 9022.1 by June 30th of each year. This form is also called the FBAR report, FBAR. Now, beginning in 2011, Section 511 requires any individual who holds more than $50,000 in a depository or custodial account maintained by a foreign financial institution to report any such account. So beginning in 2011, individuals with more than $50,000 in foreign accounts will need to file 2 separate reports. Since Section 511 includes a wider range of investment account types, it is possible that individuals not required to file Form TD 90-22.1 will be required to report their accounts under Section 511. So we're going to take a look at each of these 2 reports in turn. And I have to confess that until about 3 years ago, I hadn't heard of any of them. Been doing tax returns for a long, long time, and they just not anything that had crossed my horizon. But what happened in 2008, I believe it was, is the IRS had an amnesty where people who had had all this money overseas and never reported it could come forward voluntarily and cough it up for less of a penalty than would otherwise be imposed. And that amnesty went relatively well, but the IRS thought it could do better, so it had another amnesty in 2011. And you may have heard that on the news, or heard about it on the news, or you may have heard about it when you received phone calls from clients who were asking about it. My office in particular was inundated with phone calls from Canada. Canadian people who've lived up in Canada since they were, I don't know, 5 years old, except they are American citizens because they were born in America, and they heard on the news that they might be in trouble because they haven't filed these FBAR reports to report the fact that they have $10,001 in a Canadian bank account. And technically the law says they are required to file the report, and technically the law says even if you are not living in the United States and you have not lived in the United States for 20 years, if you meet the filing requirements and you are a U.S. citizen or green card holder, you are required to file an American tax return. And this is a concept that seems very odd. How can I be required to file an American tax return when I don't live here? I haven't lived here for 20 years. Why should I have to file? Well, it's just American law, and when you're a citizen, you fall under that law. And if you don't like it, then you can renounce your citizenship, and then you won't have to worry about it anymore. But anyway, that's the way it works, and yes, we had lots of phone calls. So let's talk a little bit about what this FBAR report is about. So you need to file the report if you have a foreign account and it has more than $10,000 in it, or you have more than one foreign account and the combined total of those accounts is $10,000 or more at any time during the year. So it's not like what's the balance on the last day of the year. It was what was the highest balance at any time during the year. And if you hit $10,000, the report's required. So what is a foreign financial account? Well, it includes bank accounts such as savings accounts, checking accounts, and time deposits, securities accounts such as mutual funds, brokerage accounts, and securities derivatives, accounts where assets are held in a commingled fund, that is a mutual fund, as well as any other accounts maintained in a foreign financial institution or with a person doing business as a financial institution. But foreign financial accounts do not include individual bonds, notes, or stock certificates held by the filer and unsecured loans to a foreign trade or business that is not a financial institution. So the filing requirements, as I have already stated, are $10,000 at any time during the year, cumulatively in all of your accounts overseas or outside of the United States combined. The due date for filing the report is June 30th of the year following the calendar year of the reporting. So what that means is the 2011 FBAR report is due June 30th of 2012. Oddly, and maybe interestingly, it doesn't go with the tax return. The FBAR report is not a part of the tax return, but it has to be filed and it gets sent to Detroit, Michigan. So how do you file? Well, you mail the report to the address shown here. in Detroit, Michigan, or you can hand carry it to any local office of the Internal Revenue Service for forwarding to the Department of the Treasury in Detroit, Michigan. Also, tax attachés are located at U.S. embassies in some countries, and a filer can receive instructions for verifying that a report has been filed by calling the Detroit Computing Center. There is no extension of time to file the report. If you file the report late, or maybe you're filing multiple reports for multiple years all at one time because, hello, you just found out you were supposed to do it and you've gone 20 years without doing it because you didn't know, you need to attach a statement explaining the reason for the late filing. Now, there's two things that go on with late filing of a FBAR report or FBAR report. The first part is, all right, I didn't know I was supposed to file the report, but I've always reported all of my income. So from a tax aspect, I had overseas money, maybe $100,000 overseas, in an account, and every year it generates interest, and I always report that interest on my tax return. Well, you've partially complied with the law because you knew you were supposed to report the income, and you did. But there was this FBAR report that you didn't know about, and you never sent it in, so now what? Well, there's pretty stiff penalties for failure to file the FBAR report, but the IRS also does have reasonable cause exceptions where you can ask for leniency from penalties. And of course, a reasonable exception that could be granted is a person who absolutely had no idea they were required to file it and didn't because they didn't know about it. During this amnesty period, we had lots of phone calls from lots of panicky people wanting to know what to do. And when I called the helplines, they were very unhelpful. My conclusion is that if a person wants to come forward voluntarily and report the fact that they have these accounts and they don't owe any income tax as a result of it, that if they had filed U.S. tax returns, they wouldn't have owed any money, or if they did file U.S. tax returns, they reported the money on there, they're probably going to get away with it. But if you're the other side of the coin where you've had these overseas accounts, you've never filed FBAR reports, and you also have never reported the income, that was what the amnesty was for, and it's over, unless the IRS comes up with another amnesty. So what are the penalties? Well, these are some of the most severe penalties I have ever seen when it comes to IRS. Firstly, we have a negligent violation. Negligence is you should have did it and you didn't, and it's $500, which that doesn't seem to be that bad. But then there's something called a non-willful violation, up to $10,000 for each negligent violation. Pattern of negligent activity, $50,000. Willful failure to file FBAR. That means you knew you were supposed to file it and you deliberately didn't. The greater of $100,000 or 50% of the amount in the account at any time during the violation. So let's just suppose you had $2 million overseas and you knew you should file the report, you never filed it. The IRS, through its associations with foreign countries and their financial institutions, finds out you've got $2 million hidden away and you've never reported it. They're entitled to half of it. That's the penalty. So the amnesty was settling for something like only 25 or 30% of it. It's a good deal. But there was someone in our office said that they managed to collect $34 billion in the amnesty effort, so it's been somewhat effective. I may be off on my number, but that's what sticks in my head. So that's the FBAR report, and it's been around for a while. It only became a focus, or something that at least moved into my sphere of recognition, in 2008 when the first amnesty came along. And of course, ever since then, I've been pushing it and making sure I ask my clients, do you have more than $10,000 overseas? That's just one of the questions I ask now. But beginning in 2011, we have a new form and a new reporting requirement. And this form is called FATCA. Maybe for fat cat, I'm not sure. No, it's an abbreviation of a longer phrase. And you're going to file your FATCA report on Form 8938, Statement of Financial Foreign Financial Accounts. For tax years beginning after March 18, 2010, the IRS is requiring individuals to report certain financial assets if the value of those assets exceeds $50,000. A new form, Form 8938, is filed in the following situations. Firstly, if you are a specified individual. So what is a specified individual? Well, you're a specified individual if you are a U.S. citizen, or you are a resident alien of the United States for any part of the tax year, or you are a non-resident alien who made an election to file a joint return with a resident alien, or you elected to be treated as a resident alien. And finally, a non-resident alien who is a bona fide resident of American Samoa or Puerto Rico. And you have an interest in a specified foreign financial assets that are required to be reported. So what is a specified foreign financial asset? Well, it includes any financial account maintained by a foreign financial institution, other foreign financial assets held for investment that are not in an account maintained by a U.S. or foreign financial institution, such as stock or securities issued by someone other than a U.S. person, any interest in a foreign entity, and any financial instrument or contract that has an issuer or counterparty that is not a U.S. person. So essentially, if you have money invested in a company overseas, such as a brokerage account or a bank account or a mutual fund, this is you. And if you have more than $50,000 invested in these accounts, you need to file the new form. And in most of these situations, you also need to be filing the FBAR report. So what does it mean when they're talking about the filing requirement? The IRS is saying if you have an aggregate fair market value in your specified foreign financial accounts that is more than the reporting thresholds that apply to you, you're required to file. $50,000 is the amount for an unmarried person. If you are married, that amount is $100,000. So what they're looking at is on the last day of the year, did you have $50,000? And if you didn't, at any point during the year, was the account worth $75,000 or more? If you're married, on the last day of the year, did you have $100,000? Or if not, on the last day of the year, $100,000, was there at least $150,000 in there at the highest point during the year? Now, there is a different calculation for taxpayers who are living abroad. If you live abroad, you are allowed to have more money before you're required to file the form. Please note that if you do not have to file an income tax return for the year, you do not need to file Form 8938, even if the value of your specified foreign assets is more than the appropriate reporting threshold. If you are required to file Form 8938, you do not have to report financial accounts that are maintained by a U.S. payer, such as a U.S. domestic financial institution, the foreign branch of a U.S. financial institution, or the U.S. branch of a foreign financial institution. So if you open up an account with a foreign financial institution in a city here in the United States, you don't need to file the report. And if you happen to have money invested in an American financial institution that has a branch overseas, that also is not a situation where you have to file the report. The rules are really looking at those foreign financial companies that have nothing to do with America and you've invested your money in them. You, of course, could have American stocks and so forth, but the point is who has control, and the other side of it is, are those companies issuing 1099 documents to the Treasury Service? So American banks and American financial institutions issue 1099 INTs, 1099 DIVs, and 1099 Bs to report interest, dividends, and stock sales. Those foreign financial institutions don't do that. So if they have a 1099 document, then you don't report that income on the new form. If they don't have a 1099 document, and the reason they don't is because it's overseas, then you need to report it on the form. Also, the IRS says currently that the only people required to file the form are individuals, although it does anticipate issuing regulations that state that a domestic entity will be required to file the form if it holds foreign assets. So in other words, right now, if the foreign assets are held through a partnership, the IRS is not requiring the partnership to file 8938. But if they're held by an individual, the IRS is requiring that the individual file it. However, it is expecting, I presume in the near future, that it will impose that requirement on partnerships, S corporations, and other corporations. And at the time that that happens, then the form will need to be filed by those entities as well. So here is Form 8938, and you can see it asks for all kinds of information, including the address, the type of account. So it's asking for the address of the company that the account is in, and the name of the company, and the foreign currency that you hold the account in. And it goes on to page 2, and on page 2 it actually asks, what kind of income was generated by that account, and what line of your tax return did you report the income on? Lest there be any doubt that it is taxable, because of course it is. All right, we're going to move on now to Form 1040 lines 12, 17, and 18, and of course those are the lines that we report self-employment income on for the most part. Of course, rental income is also reported on line 17, but typically we're reporting on line 12 self-employment income, and if you have ownership in a partnership or an S corporation, your share of profit or loss and your share of any credits that might be available to you flow through to you onto your personal return from the return that was filed by that entity. So we're going to talk about tax rules that are affecting Schedule C, but also tax rules that will affect individual filers who have ownership in these entities that have the flow through. We're going to talk about them mostly in relation to Schedule C, but all of the rules that we're talking about also impact these other entities and can affect individual filers who have ownership in these other types of entities. So taking a look at Schedule C, the first thing we see is that information reporting requirements have been added to the form in that new lines I and J have been introduced regarding the required filings of Form 1099 in 2011. Now the filing of Form 1099, and I've just got my arrow down here, it's lines I and J that I'm talking about. 1099 is not a new form. It's been around forever. Well, I've been at it 20 years, and it was here 20 years ago. So how far they go historically, I don't know. But 20 years ago, we had these rules that you had to file 1099s, and that's not changed. What's changed is the focus on them. And so to emphasize the focus the IRS is now giving to these forms, it's added a line to the Schedule C. And the line says, if you look at line I, did you make any payments in 2011 that would require you to file Forms 1099? Yes or no? Question number J, if yes, did you or will you file all the required Form 1099s? Yes or no? What happens if you're supposed to file and don't? Well, we're going to spend some time talking about that. Because, you know, one of the things we deal with as tax preparers is small business owners who come in and they don't know what the rules are, and very often they don't want to know what the rules are. They want their life to be as simple as possible because, after all, if you've got a contractor who's working on construction sites and he comes in and you ask him, did you send out your 1099s? He's going to go, what 1099s? Why do I have to do that? I don't see why I have to do that. That's ridiculous. This is too much work. And a lot of these folks just haven't sent out 1099s and gotten away with it for many, many years. But I think those years are up. That now when these forms are not issued, the IRS is going to be coming down on people and the penalties can be quite severe. And if our client should have filed a 1099 and we did not make that happen for them, who will they blame when they get the letter from the IRS? Well, typically they like to blame me because so that's why I take written notes when a client says they don't want to do something. I write down the fact that I asked them about it and they said no. Because 3 years later when they get the audit and they start to come back on me, I want to say, hey dude, we talked about this and you said no. So not only do we talk about it, now I emphasize the penalties, and we're going to learn what those penalties are today. So who's supposed to get a 1099? Well, in general, the rule is $600. If you paid a person who is not a corporation $600 or more during the year, you have to 1099 miscellaneous them, typically with Box 7 non-employee compensation. Now, one that might not be as well known is rent. How many of us make rent checks for our tax service businesses out to a landlord who is not incorporated? Well, it's safe to say we're going to pay out more than $600 of rent in a year for our office. And most of our clients who have business locations and are paying rent will also be paying rent. And it will be more than $600 for the year easily. So pretty much when you have rent showing on the expense line of a Schedule C, there should be a 1099 going out unless you're able to establish that the entity that received that rent check was a corporation. If it was an LLC, you need to 1099 it. If it was a partnership, you need to 1099 it. If it was an individual, you need to 1099 it. If it was a corporation, you do not need to 1099 it. What's another one? Oh, commissions and fees and contract labor. Well, those ones are kind of more self-evident. I think we've understood for a while that those types of people are supposed to get 1099'd. But what I can tell you is that I've been at taxes long enough to have figured out what's going on when my clients get selected for audit. And this happens at the state level as well as at the federal level, that a Schedule C will be examined and it will be observed by the IRS or the state that there's a big number on the form for contract or commissions and fees, and no 1099 was issued. They can see that there was no 1099 out here, and they can see there's a big number on the Schedule C, audit time. So if your clients don't want to get audited, that would be a really good reason to be 1099ing. And so the IRS is looking for big differences. Now, if you've got a line on the tax form that says $2,000 was paid out in commissions and fees and no 1099s are issued, that won't necessarily trigger an audit because you could have sent out four $500 checks to 4 different individuals, none of whom received more than $600. So technically, you don't need to 1099 in those situations. But by the time you're getting $5,000, $10,000, $20,000 on that line, and there's no 1099s going on out there, doesn't mean you will get audited. It just means the likelihood is going up, that the computers that go through and make these decisions are going to be pulling you. And your Schedule C that was pulled because of numbers that appeared on it gets on the desk of an Internal Revenue Service agent who looks at the numbers and makes a decision whether or not your number's up. And if your number's up, then it goes to another person who actually makes the phone call and sends out the letter, and you have to start bringing in your receipts and your records. Now let's look at the bottom of the Schedule C here. You'll see that we have also some new lines that have been added. One of those is merchant card and third-party payments for 2011. Enter 0. I think that's rather funny. I'll tell you why. Then it says on line B, gross receipts or sales not allowed or not entered on line 1A. See instructions. Well, the bottom line of what's going on with lines 1A and 1B is this new form called Form 1099-K. Now, why do we have a Form 1099-K? Well, we have a Form 1099-K for 2 reasons. One is to ease the burden on businesses for tracking their income. I think that's less of an issue than the other side of the equation is, which is closing the tax gap. And basically figuring out who's making money, where they're making that money from, and then collecting it. And the 1099-K is issued to any business that accepts credit cards whatsoever. If you swipe a credit card and it charged 50 cents during the entire year, you're going to get a 1099-K. The other people who are going to get 1099-Ks are the people who do online transactions, such as through Google and through PayPal. There could be other network party providers beyond those 2, but those are the 2 big ones that IRS likes to use as illustrations. And how many of us have clients who are doing business on eBay? How many of us have relatives or friends doing business on eBay? Okay. So, and it's been quite, you might say, an underground operation out there with people really making good businesses for themselves on eBay and not reporting any of it, because there's never been a method for tracking this up until now. But there is a de minimis factor in there, which is getting people off a lot of slack, I personally think, which says that if you're taking transactions through PayPal, for example, the number of the transactions has to exceed 200, and the gross receipts that you've run through that PayPal system have to exceed $20,000 before the 1099-K will be issued. Now remember the difference there. If you swipe 50 cents on a credit card because you have a credit card machine for your business and you collected 50 cents, you're going to get a 1099-K. The de minimis amount of 200 transactions and $20,000 applies only to these third-party network accounts like Google and eBay. So we'll see here that we've got a picture of the 1099-K. It shows the gross receipts that were collected during the year, and there's been a lot of questions. I spent a lot of time reading up on this 1099-K, and the types of questions people were asking, well, what if I take a debit card and I give cash back? Is that going to be reflected in there? You know, am I going to have to pay tax because I collected money and gave cash back? The systems themselves are supposed to account for that. Also, there's no personal information about the credit card holders that is reported on here. Rather, it is broken down by month. You, as a merchant vendor, collected $20,000 in the month of January. You collected $15,000 in the month of February, and it's broken down by month. But there's no information on here about who the money came from. Other than that, it was run through this merchant account. So there's more information in here if you want to read about it. The biggest and most important thing is duplicate reporting. And this is why the Schedule C says enter the amount shown on 1099-K, but for 2011, don't enter it. And we're using, or the IRS is looking at 2011 tax returns as being kind of a test phase for the 1099-Ks. What they don't want to see happening is have a business report gross receipts from here and then add the 1099-K in on top. That the 1099-K is separate and a part of the total receipts of the business, but they want it separately reported in future years. So on 2012 returns, 1099-Ks are going to come, and we're going to see our customer had a 1099-K and they received a certain amount of income from that, and we're going to put that on the income line for 1099-K on their Schedule C. And any other income they had for the year from any other source is going to go on the other line. For 2011, they're saying, no, put it all together. But while you're putting it all together, make sure you're not duplicating. Now, duplication can happen in two ways. One of the ways duplication can happen is you take all of the money that you counted for the year and you add the 1099-K on top of it, and that equals more than you actually made. So you want to make sure your accounting knows exactly how much you made so that in the future you can subtract 1099-K out and separately report it and you have a proper total. The flip side of it is the business owner who is making payments out to vendors. So I run a business, and during the year I had a repairman come into my business. And I wrote my repairman a check, and he's not a corporation, and I paid him $1,000 to fix the heating and air conditioning system. So I'm supposed to 1099 him on a 1099 miscellaneous. Thing is, I gave him my credit card, and he swiped a credit card, and because he swiped a credit card and that's how he was paid, I don't need to 1099 miscellaneous him because it was reported on the 1099-K. So the IRS does not want businesses to be duplicate reporting. So what that means is business owners have to pay attention to how they're paying their vendors. And when you pay a vendor more than $600 in the year in the form of a cash or a check, you need to 1099 them. And if you paid your vendor any amount of money with a credit card, you don't need to 1099 them. And so what we're going to see as tax preparers is we may have clients who come in and they have a 1099 miscellaneous and they have a 1099-K, and the total of those is more than they made. So this is a potential problem that the IRS is aware of, and the way around it is education and training. And that starts with us. Okay. So now let's talk a little bit about the 1099 miscellaneous process, because I think I've explained what a 1099-K is and what we're supposed to do with it. We're not typically going to be issuing 1099-Ks ourselves, but we will be issuing 1099 miscellaneouses for our own businesses and for our customers who ask us to help them with that. So let's talk a little bit about what's involved in 1099 reporting. The first rule about 1099 reporting, and I'm on page 18, is that you should issue a 1099 miscellaneous only when you made payments in the course of your business. So as an individual, if the repairman came out and worked on your house, you wouldn't 1099 them. But if you have a business and the repairman came in and helped you in your business and you wrote him a check for more than $600 or you paid him more than $600 cumulatively for the year, then you would need to 1099 them. And there are some exceptions to the rule, and there's also some additions to the rule. The biggest exception is that you don't need to 1099 corporations. There was a provision in new tax laws that were passed at the end of 2010 that would have required businesses to 1099 corporations. And the concept was so drastic that if you went down to Costco and bought supplies for your business, or Office Depot and bought supplies for your business, and at the end of the year you'd paid that business more than $600 for your office supplies, you were supposed to 1099 them. Well, there was a big outroar over that, and it was repealed. So if you have clients asking, do I have to do that, the answer is no, because that was repealed in 2011. So I said that we'd take a break every hour, and I can see we're at 5 minutes to the hour. So let's take our first 10-minute break. And if any of you had questions for me, now is the time to ask them. And I do see Rich Van Paris asked, does that mean mutual funds by U.S. fund families that have international mutual funds? Rich, the answer to your question is, if this is an overseas mutual fund that is generating income for a holder, that holder has interest in the fund, and that interest is $50,000 or more cumulatively for all funds overseas, they're going to need to be filing. All right, so I had a number of questions that came up in the chat and in the classroom about specifics of some of the things that I've already talked about today. And most every question that I was asked is addressed in the manual. So if you, wait, she didn't talk about this. It's because I didn't have time. There isn't time in today's class to really burrow in on every single topic. But if you have a question about a topic that I am talking about, when the break comes, flip to that section of the manual and see if it's there. And if not, then I'll be happy to answer what questions I have. But pretty much every question that went up, including the Canadian question, is in the manual. All right, so nominee reporting requirements is where we're going to pick up. Now, has it ever happened that somebody got a 1099 with their name on it and their Social Security number on it, except it wasn't their income that was being reported because, well, they gave their social, they opened up an account with someone else, and the money is really someone else's? Well, we're used to that in the world of banking, that you might open up a joint account with, say, your child, and it's your child's account, but the income is reported to you, and it's really your child's money. So what do? Well, there is a system called nominee reporting, where essentially you 1099 the other individual to get that income off of you. And on a Schedule B, where you report interest income, it's actually possible to enter negative interest because you nominated it out to someone. Well, there's actually a nominee process similar to that that is in effect for 1099 miscellaneouses. And it's not a hugely common thing, but it does come up from time to time that we have a client who got a 1099 for money that was really for someone else. Maybe they were the middleman in a transaction. And now they've got the 1099, but it was really money that was paid out. Well, the solution to that is to, well, since you paid it out, 1099 the person that you paid out to and claim that as an expense. So that system called nominee reporting, I've got a little bit of information in here on that and how you are supposed to do it. And where and when to file your 1099s by. So you're supposed to file a 1099 to any individual that you paid $600 or more to during the year. Oh, and there was an exception I talked about earlier. You don't have to 1099 someone if they are a corporation, except if the corporation is an attorney. So no matter what, lawyers get 1099'd. Incorporated or not incorporated, lawyers get 1099'd. There was also a question in the classroom, is an LLC someone I have to 1099? The answer is yes. An LLC is typically either a sole proprietor or a partnership, neither of which are corporations. And IRS says if the name incorporated or Inc. is in the name, you can assume that they are in fact a corporation. But if they call themselves Johanna's Cleaning Company, you may not assume that that means that they're incorporated, because the word company does not mean that a company is incorporated. Okay, so you're supposed to 1099 people, and what happens when you don't, and also what happens when you do, but IRS is unhappy with how you did it. Well, this is quite a common thing, and this year my phone started ringing with phone calls from my various business clients who were asking me, I got this CP 2100 notice, and it's talking about B notices. What do I do? And I said, I don't know, but I'll find out for you. Give me 5 minutes. And I got enough of these phone calls that obviously I only had to research it the first time. But this is the latest new enforcement effort on the part of the IRS, and that is to ensure that people who file 1099 reports are filing them for the people they are required to file them for, and that the 1099 documents contain valid Social Security numbers or tax identification numbers. and that if the number is invalid, you're going to hear from the IRS because it's invalid. So what happens when you get a CP 2100 notice, or why did you get it? Well, you're a business owner and you've been working really hard and you're collecting the 1099 information from the people that you're supposed to 1099, and you're 1099ing them like you're supposed to. You're writing out all those little 1099 miscellaneouses and you're mailing them off and you're tracking it and you're sending your 1096 to IRS. You're doing everything you're supposed to. And then you get this CP 2100 notice that says it's wrong. So let's talk a little bit about the steps and what generates a CP 2100 notice. A CP 2100 notice is a notice to a business owner from the IRS that the name and identification number on the 1099 form submitted do not match. Now, from a taxpayer perspective, we are used to seeing this on W-2s and on tax returns themselves, that when we prepare a tax return and electronically submit it to the IRS, that the IRS is matching the first 4 letters of the last name of the taxpayer against the Social Security number on record with the Social Security Administration. And if there is a mismatch, that tax return rejects. That particular system has been in place since the advent of electronic filing. We're going back to the late 80s, that the IRS has been doing these matches. They are now doing it on 1099s. The 1099s are often mailed in paper. Sometimes they're submitted electronically. Big businesses certainly do it that way. But when we're dealing with our clients and they're sending out 2 or 3 for the year as a small business owner, they're probably hand filling out the 1099s, they're hand filling out the 1096, and they're putting it in an envelope and sending it off, or you're doing that for them. And then it gets to IRS, and IRS is running it through their system, and they're seeing that there's mismatches. When they find a mismatch, they send a letter, a CP 2100 letter. And that CP 2100 letter says, you have a mismatch. And then the client calls you and says, I don't know what to do. So there's specific procedures in place that have to be followed. The first procedure is that when you hire, for example, an employee, you're supposed to verify their entitlement to work in the United States. You have them fill out an immigration form, an I-9 form. You give them a W4, thank you. W-9 is what I'm going to talk about next, W-4. You give them a W-4, and on the W-4 they indicate their name, their Social Security number, how many exemptions they want claimed, and so forth, right? We're used to that for payroll. But did you know that when you do 1099ing, you're supposed to do something similar, except you don't use a W-4, you use a W-9. And the W-9 is something that you hand to that contractor who just fixed your furnace, and you say, would you please fill this out for me? And the contractor says, I'm not giving you my Social Security number. And you respond back saying, but you have to. And it's a $50 fine to you if you don't. And if the contractor says, I refuse, then the law says you as a business owner have to hold out 28% and send it to IRS. So at the very first time that you engage in a business transaction with that unincorporated entity, you should be asking that unincorporated entity to complete a W-9. Or even if they are incorporated, have them complete a W-9 to tell you that they're incorporated. That way you're covered. And then you keep that W-9 in your records. So the IRS says the first time you begin business with that individual, ask them to complete the W-9, and if they refuse, begin backup withholding immediately. In addition to that, you need to make a first annual solicitation. So you asked at the time, like you were supposed to, or well, maybe you didn't because you didn't know you were supposed to, but at some point you need to make that first initial solicitation. If at the end of the initial solicitation you still do not have the correct information, then you have to make a first annual solicitation. And this is what happens with a first annual solicitation. If the payee does not provide a TIN after initial solicitation, you must make a first annual solicitation by December 31st of the year in which the account is opened. That means, let's just say in September the furnace repairman came out, and at that time you asked him to fill out a W-9 and you gave it to him and he never sent it in. By December 31st you have to mail him another W-9 with a letter requesting the information. And you should already have started backup withholding at that point. And if you hadn't, you'd better start. Now you're given until January 31 of the following year if the account was opened in December. So like if the furnace repairman came out in December, and that was the first time you'd ever done business with him, you could make that first annual solicitation as late as January 31 of the next year. Now, there's also something called a second annual solicitation. If the payee does not provide a TIN after the first annual solicitation, you must make the second annual solicitation by December 31st of the year following the calendar year in which the account was opened. So furnace repairman comes out in September, you ask him for his information, you give him a W-9, he goes, and he leaves and he never sends it in. And you pay him because, well, you're nice. Now he hasn't sent it in, so by December 31st of 2011, you send him the first annual notice with a W-9 in it and a request for the information. And a year later, you still don't have the information, you need to send out a second annual solicitation. And if those letters that you send out are returned to you, the IRS wants you to save them to prove that you made the solicitations. And of course, by the time it was refused up here on the initial, backup withholding should have started. And my recommendation is that the best time ever to get a number out of anyone is while you've still got their money. Once you've paid them, they're going to be less inclined to give you that information. But if they understand the space between me and that $1,000 check is filling this W-9 form out, they're probably going to fill it out. But if you've already paid them and then you ask them to fill out a W-9, it's much harder. So it just should be standard procedure right up front when that contractor walks in the door and he's asking for a check, you're handing the W-9 and say, just fill this out and we'll get it in the mail to you. Now, of course, if you pay him with credit card, then you don't have to 1099 him. Okay, so let's suppose you did all of that correctly and the number they give you is wrong. Now what? Well, it's the same exact procedure. So maybe you ask them to fill out a W-9 and they put a bogus number on it. How would you know it's a bogus number? Well, you may not know it's a bogus number, but you're still going to get that CP 2100 letter. And so if the notice comes that there is a mismatch, now you have to send out the first annual notice and begin backup withholding. So they gave you a number, you believed it was correct, you did not backup withhold. Now you've gotten a notice from the IRS saying the number is bad. You need to notify the individual in writing with a W-9 enclosed, stating you need to give me your number, and it needs to be accurate. And if after you've done that, the IRS says it's still inaccurate, then you need to send out a second notice. And information about what these notices should contain is in the manual. I'm not going to read it to you just because of time restrictions. But for those of you who are concerned with it, it's all there in writing in front of you. Now, I did have a question that came, I think in the classroom, but maybe also online. What about foreign people? Do I have to back up withhold on foreign people? And as I said, this is not a class on foreign entities and foreign reporting. I'm not prepared to talk about it. But I did include information about what to do in terms of collecting reporting information from a foreign person. And in that case, you use Form W-8. And there happens to be more than one kind of Form W-8. So if you are dealing with a foreign person, spend some time researching that before you take action. And of course, information is provided on Form W-8 in Publication 515, Withholding of Tax on Non-Resident Aliens and Foreign Entities. But that would be a class all by itself. Okay, so what happens if you're supposed to back up withhold and you don't? And on the other side of things, what if someone asks you for your number and you refuse to give it? Well, firstly, there is a general law on the record under some section code that says if your number, your identification number, is required for reporting purposes on the tax return of another person or business and you refuse to give it, $50 penalty to you for refusing to give it. We could be talking about you're filing your personal return and you're claiming a deduction for alimony you paid to your ex-spouse and she won't give you her social security number. Now you should know that anyway, but technically that would be an example of where you're required to have that number to put it on your return and the spouse refuses to give it, $50 fine on the spouse. Or you're paying for child care services and the child care provider refuses to provide you with their identification number that you need so that you can claim a credit for the child care expense on Form 2441. $50 fine to the provider. I think it should be bigger, but that's where we are there. So failure to issue or provide an ITIN or TIN when it's asked for is a penalty. On the flip side of things, what happens if you are a business and you should have done backup withholding and you did not? Well, if you're required to do backup withholding and you don't, the worst case scenario is the government comes along and makes you pay the tax you didn't hold out. And 28% of $1,000 would be $280. So the backup withholding requirements and the penalties for failure to do backup withholding are technically quite severe. So if you made out a whole bunch of payments and you've been told by IRS that these Social Security numbers are invalid, or if you've been told to do backup withholding and you don't, the IRS can come along and make you pay the withholding you never held out. All right, so there's more information on backup withholding in here and other backup withholding rules. I wanted to get to the point where we talk about name controls, because these impact not just 1099s, but they also impact the filing of tax returns. And I've known this information for many years. I've spent many years and hours explaining to my staff how name controls work. And then I came across IRS information that actually explained it. This is straight out of IRS's publications or information online about how they do name control matching. And firstly, we have individuals. When you file a tax return or a tax form, such as a W-2 or 1099, the IRS is going to look at the first 4 letters of the last name and match those against the Social Security number that they have on record. If the person is not eligible for a Social Security number because they have an ITIN, they're a non-resident alien not eligible, then they will receive their ITIN from the IRS, and the IRS will use the same matching process, the first 4 letters of the last name. So they give some examples here, and I've underlined what the coding is that they're looking for. And you can see Joe McCedar, they've got MCCE, that's what they're looking at. But it could be the case that it's Joe McSpace Cedar, and IRS will look for that space. So I've seen situations where you've got a family of, say, Macbeths, and we've got MC space M on one Social Security card and an MC no space M on the next Social Security card, and they both say Macbeth, or MCB, pardon me. They both say Macbeth, but one has a space and one doesn't, and you have to copy that completely the way it's showing. If there is a space, you keep it. If there is no space, you don't add a space, because that can cause a reject. It also talks about how name controls look on a Schedule C, how name controls should look on the tax return of an estate. For example, we have the Frank White estate. The IRS is going to be looking at WHIT and matching to that. So they're looking for the last name of the individual who died. Trusts of fiduciaries, they're looking for the last name of the individual for whom the trust has been set up. In this case, they've got Jonathan Periwinkle, and they're looking at PERI, or in the case of a church, Memory Church Endowment Trust, they just went for MEMO. Partnerships, again, they're looking at the wording in the name, but they've dropped the word the. So we have the oak tree, and what they've done is they've dropped the word the, and they've gone to oak and included a space and then put T. And there's other examples in there. So this can be helpful to you just from electronic filing purposes. If you are trying to file a tax return electronically and you're getting rejects, this can give you some help in making those go through. The next thing we're going to talk about is employer payroll benefits. And most of the big changes that came into play in the 11th hour of 2010 that benefited small business had to do with tax breaks to do with hiring people, incentives to hire. So the rules are not new to 2011 for the most part. They're a continuation of what we saw in 2010, but they're relatively new still, and there were some changes, so we're going to talk about them a little. The first 2 that we're going to focus on are the Work Opportunity Credit and the New Hire Retention Credit. And we're going to start with the New Hire Retention Credit. This is a credit that is going to be available to a large number of businesses who have employees that they've hired during the year. This credit is given to a small business that hires a worker who was unemployed for 60 days or more on the date that they were hired. And that individual was hired in 2010, and that individual was employed for a full year. For most people who hired a worker in 2010, this worker will have worked for part of 2010 and into 2011. But the credit is claimed on the 2011 tax return. There are some organizations out there that are fiscal year filers where it was feasibly possible that their tax year ended in 2011, but not at the end of 2011. And those individuals may have been able to claim it on 2010 returns. Actually, it wasn't even that. The wording was for tax years that end after March something in 2010, the credit is claimed on that year. And for fiscal year filers, there's a small number of companies out there that would be claiming it on 2010 returns. But for the most part, this is a 2011 credit. And the credit itself is the lesser of $1,000 or 6.2% of the wages paid by the employer to the retained qualified employee during the 52 consecutive week period. The qualified employee's wages for employment during the last 26 weeks must equal at least 80% of the wages in the first 26 weeks. All remuneration that is considered wages for federal income tax withholding purposes is counted in terms of computing this credit. There's a number of rules that are going on here. Firstly, the worker cannot have been hired to replace another worker unless that other worker quit or was fired for just cause. So they didn't want people saying, oh, I can get a credit if I hire a new worker, let's can so-and-so. All right. But if so-and-so quit, or if there was a legitimate need to hire a new worker, the federal government was hoping that this would be an incentive. And it's basically a kickback on the employer's share of Social Security, up to $1,000. So if you have a client who hired workers in 2010 that worked through 2011, and you can show that that worker was unemployed for 60 days before they were hired, and that what they earned in the second 26 weeks of employment was at least as much as 80% as much of what they were earned in the first 26 weeks of employment, they're eligible for a credit. And it's a credit off of the income tax of the business. And if the business is a sole proprietor, it's going to be claimed against the income tax of the individual. If it's a partnership or an S corporation, it will flow through to the individual. Yes? It's per employee who meets the requirements. Now, the IRS has a form that employers need to have the employee sign, or the employee needs to sign a similar statement containing the same information. The form is Form W11, and it essentially certifies that the employee is saying, yes, I was unemployed for 60 days, and I qualify. So the employee has nothing to gain by this. It's the employer who has everything to gain. But it's up to the employer to ask the employee to sign the form. So if the employee can sign the form saying, yeah, I was unemployed for 60 days before you hired me, then the business can show, oh, I hired this worker in 2010, and I kept them employed for a full year, and I paid them at least 80% as much in the second half of the year as I did in the first half. Now I'm eligible for a credit. The credit is the lesser of 6.2% of the wages paid, or $1,000. And a question I did ask the IRS at one of their forums is, what does hire mean? Does it mean the day they started working, or is it the day that you said, I'll hire you and you can start in 2 weeks? And the answer is, it's the day you hired them. So you could technically hire a person on December 20th, 2010, and that worker may not have started until the new year, and they're going to meet the requirement and be able to qualify you for that credit. For tax service owners, that's important because we might hire someone in December but not start them till January, right? So I was very motivated by this. All right, so who can claim the credit? Taxable businesses, tax-exempt organizations, taxable businesses and tax-exempt organizations in the 5 U.S. territories, public colleges and universities, and Indian tribal governments. Who cannot claim the credit? Household employers, so if you have your nanny or your housekeeper, sorry, you're out of luck, and federal, state, and local government employers other than colleges and universities. So how do you claim the credit, or when do you claim the credit? You claim the credit typically on your 2011 return by attaching the appropriate form. And here is the first password of the day. My home country, Canada. So for those of you who are online, please jot this down. C-A-N-A-D-A, Canada. Okay, how to claim the new hire retention credit. You fill out this form, and of course on the form you indicate the worker, the Social Security number of the worker, the amount that you paid the worker. You verify that the worker's wages were at least 80% as much in the second half of the year as in the first half of the year. You do a calculation and you come up with a number less than 1,000, or you are limited to 1,000. The next credit we're going to talk about is the Work Opportunity Credit. And this is actually a pretty amazing credit, but it's technical in terms of getting it. If a small business qualifies for this credit, they have to do some legwork ahead of time. It's not a, oh, I found out about the credit after the fact thing. You have to have known about the credit ahead of time and taken the appropriate steps at the time you hired the worker or immediately prior to hiring the worker. It's not a credit you can take advantage of 6 months later because you found out about it after you hired them. But it is still in effect all the way through 2012 for one particular group of workers. For most people, it's expired as of the end of 2011, but there was late legislation in 2011 that carries it through 2012 for businesses that hire veterans, a certain group of veterans. So the Work Opportunity Credit is intended to encourage employers to hire individuals from targeted groups. It is equal to 40% of up to $6,000 of the targeted employee's qualified first-year wages, subject to certain requirements and limitations. It was originally scheduled to expire at the end of August in 2011. However, legislation extended it all the way through the end of 2011. And for certain targeted veterans, the Vow to Hire Heroes Act extends the Work Opportunity Credit all the way through 2013. So these are the groups that are eligible for the credits, and they include long-term TANF recipients, certain disabled veterans, certain 18 to 39-year-old SNAP or food stamp benefit recipients, 89 to 39-year-old designated community residents, 16 to 17-year-old summer youths, vocational rehabilitation referrals, ex-felons, Social Security or SSI recipients, that's disability insurance recipients, and unemployed veterans. The main objective of the credit is to enable the targeted employees to gradually move from economic dependency to self-sufficiency. In other words, get them off welfare and unemployment benefits and into a business working. And businesses are often reluctant to hire people from these groups, maybe because they feel they're risky or maybe because they feel they don't perform very well. So at any event, they deliberately don't hire people from those groups, and this is an incentive to maybe make an exception and hire from it. Now, if you want to hire a person from those groups, you have to go through a screening process. You have to submit forms. You have to submit the forms at the time you hire or before you hire, and there's information in here on how to do that. At this point, because the Work Opportunity Credit has expired as of the end of 2011, there's not much we can do to counsel our clients on taking advantage of most of these groups and maybe applying for the Work Opportunity Credit, with the exception of veterans. Because the credit has been extended for veterans, there still is an incentive out there for a business to hire a veteran, and as a tax preparer working with a business client, it would be good for us to be able to say to our client, hey, if you're going to be doing any hiring, there is a credit out there if you hire certain veterans. So what is new regarding the credit for veterans? Well, on November 21 of 2011, President Obama signed into law the Vow to Hire Heroes Act and the Returning Heroes and Wounded Warriors Work Opportunity Tax Credit came into being. And so what does it include? Well, it extends the current target group for veterans and other people through the end of 2011 because it was supposed to end at the end of August. But it also establishes a new target group for unemployed veterans similar to the Recovery Act of 2009. Veterans who are unemployed for at least 4 weeks with a qualified wage cap of $6,000 and a maximum credit of $2,400. So if you want to hire a military veteran and that worker has been unemployed for at least 4 weeks and you want to hire them, before you actually hire them, this is some paperwork you could file, or at the time you're hiring them, you should apply for the credit. And veterans unemployed for at least 6 months with qualified wage cap of $14,000 and a maximum credit of $5,600. So if you hire a veteran that's been employed for 6 months or more, the credit is even bigger. State workforce agencies will certify veterans as meeting the required periods of unemployment based on receipt of unemployment insurance compensation. So how are these credits claimed on the tax return of a sole proprietor? Well, the sole proprietor clearly would have to have employees. Now, most businesses don't operate as sole proprietorships anymore. They're probably going to have formed an S corporation, or they're going to be an LLC partnership. But in either case, that credit is claimed and then flows through to the individual tax return. So even if you're preparing a tax return for a person and it's just their personal return, they're not even reporting a business on it, they could have a K-1, and that K-1 could be flowing through these credits. So there's two reasons why it appears on a personal return. One is the individual return is filing a Schedule C or a Schedule F, and the credit is a part of that. The second reason is that the tax return is being filed and there is a K-1 flowing through income and credits from a partnership or an S corporation, and the credit is flowing through from those. The next credit we're going to talk about is the credit for employee small employer health insurance premiums. This credit actually came into being for 2010, and it runs through 2013 and any 2 years later. It's a specific credit that targets small employers with fewer than 50 employees, and those employers have to pay average wages below a certain threshold. So businesses that pretty much pay low wages to workers or have a small number of workers historically are the types of businesses who don't offer health insurance because they can't afford to. And this particular law and this particular credit has come into being to encourage these businesses to say, hey, maybe I'm going to be able to afford this credit now, or maybe I can figure out how to make this credit work because of this extra incentive. So the maximum credit is 35% of the premiums paid by the eligible small business for health insurance for its workers. If the business is a tax-exempt organization or a nonprofit organization, the credit is maxed out at 25%. Beginning in 2014, the credit will increase to 50% of the cost of premiums paid by eligible small employers. So the rule is, actually I had it backwards there, it's that 10 or fewer equivalent full-time employees and average annual wages of $25,000 or less. And then the credit phases out completely when you get to 25. So there's a phase out between 10 and 25 workers. If you have 10 or fewer, there's no phase out. Between 10 and 25, there's a phase out of the credit. If the average annual wage paid to the workers is $25,000 or less, there's no phase out. If your average wages paid to qualified workers during the year is between $25,000 and $50,000, there's a phase out. And once you hit $50,000 of wages, you're out. Depending on the cost of living in your area, you may find that everyone's phased out. So some high-cost areas may find that even the smallest employers are paying average wages that are well over $25,000. But in most parts of the country, 50 is a pretty good wage, and 25 is probably close to average. So who is eligible? Well, you have to have fewer than 25 workers. You have to pay annual wages on average of less than $50,000 per full-time employee. You have to maintain a qualifying health care plan arrangement, and you have to pay the premiums for your employees, and the premiums you pay must be at least 50% of the premium of single coverage. So your workers, you're offering them health insurance, you have to pay at least half the cost of that health insurance for the single coverage of a worker. Now, if that worker wants family coverage, you have to pay the equivalent of 50% of single, so you wouldn't have to pay 50% of family. Although the credit is generous enough, especially when it hits 50%, I don't know, there might be some wage negotiation that could go on there that could benefit everyone. No, we're going to get to who's not included. There's a question, what about the owners of the company? Well, I can tell you as a small business owner, that was the first place my mind went. Oh, I can get a credit. I'm an employee. No. Okay. Excluded employees. Certain related and seasonal employees may not be taken into consideration when calculating the amount of the credit. Seasonal employees working 120 days or less during the tax year are disregarded in determining full-time employees and average annual wages. However, premiums paid by the employer on behalf of seasonal employees may be counted in determining the amount of the employer's credit. Owner and employees not taken into account include sole proprietors, partners in a partnership, shareholders owning more than 2% of an S corporation, and any owners of more than 5% of any other business. Family members of these owners and partners are also not taken into account as employees. So you may not claim a credit for health insurance premiums that your business paid for your spouse, your child, a sibling, a parent, a step-parent, a niece, nephew, and uncle, any of your in-laws, or any other person that you claim on your tax return as a dependent. Darn, that nailed me. Okay, calculating employee hours of service. There's a number of formulas that go into actually figuring the credit. And when I first took a look at this a year ago, I spent 2 days trying to get my hands around this credit because it had so many rules and so many calculations. I'm just going to scroll through to a little bit farther down in the manual. And what I'd like you to do is flip to this page. It's page 46. And I have completed Form 8941 for an organization called Haflinger. Okay? And you can see that there's a bunch of numbers on this form. And I guarantee you my tax software had nothing to do with those numbers. I had to calculate every single number on this form manually, and the IRS provides me with no less than 8 worksheets to do so. So I'm not going to read the worksheets to you. There's just not enough time in the class. But I did want to explain the history behind this illustration, or the story itself. The story is that we have Haflinger, Inc., which is an S corporation, and it operates a consulting firm in Omaha, Nebraska. During the year, Haflinger pays 75% of the employee health insurance premiums to the following individuals under its employer plan. What I've done is I've highlighted in pink the people who are not considered to be full-time employees, either because they're related or they are the owner, or because they worked fewer than 120 days. So you can see we've got, and I'm on page 41, folks. You can see we've got Jason, Martha, and Samuel, and we have John. So when we're adding up the number of full-time employees, we're down to less than what you see listed, because those 4 are thrown out. But I did go down and just do a total, and what I've done here is created a table. And as a tax professional, if you have a client that you believe qualifies for this credit, you may as well ask them to provide to you all of the information you see on this table in front of you, because you cannot calculate the credit without this information. So the starting point is to get a list of all the employees and figure out how much those employees earned, the total number of hours they worked, the number of days they worked, what percentage of the premiums the employer paid, the amount of premium the employer paid, what percentage that premium was, of course, of the total cost, etc. And then you use the information to fill out the worksheets. And we have worksheet 1, we have worksheet 2, worksheet 3, worksheet 4. I'm not done yet. Worksheet 5. Okay. We keep going, and when we're finally done, we establish that the credit available to Haflinger, Inc. is $3,052. Now, the maximum credit available to Haflinger, Inc. could be as high as $5,450, because that is 75% of the premiums for the qualified workers, right? But it turns out that the average wage paid to these workers was $36,000, and of course there's a phase out of the credit when the average wage exceeds 25 but is less than 50. There was no phase out based on the number of workers, because the number of workers ended up being, in this ratio, 5. So we were well below that 10 threshold, but we were not below the $25,000 threshold. Now you'll see here that it says enter this amount on Schedule K if you are a partnership or an S corporation. And since Haflinger, Inc. is an S corporation, this $3,052 is going to carry to Schedule K on the 1120-S tax form, and it's then going to be divided up between the shareholders and be issued on each of their K-1s. And then it comes to the desk of the tax preparer, who had nothing to do with preparing the business return. And the tax preparer will now also need to complete 8941 for the individual shareholder, and another form called 3800 that we'll touch on in a minute. So for those of you who really want to know more about the credit, just read the manual. It's really detailed with a full and complete description of how to calculate the credit. And for the rest of you who don't want to have to deal with it, I'll move on to the next topic. $5,000 deduction for startup expenses. As a reminder, the deduction for startup expenses was increased to a maximum of $10,000 for expenditures made in 2010 only. Startup expenses must normally be capitalized and amortized. However, since October 22, 2004, businesses have been able to elect to deduct up to $5,000 of startup expenses for the year a business begins. The deduction is reduced dollar for dollar if the startup expenses exceed $50,000. For tax year 2011, $5,000 is the maximum startup expense you can claim. If you're claiming startup as an expense, you would enter it as an other deduction on business tax forms, such as 1120 or 1120-S, and as an other expense on the related Form 1040 Schedule C or Schedule F. Any remaining startup expense in excess of $5,000 is amortized over 180 months in Part 6 of Form 4562. So if you want more information about how to do those calculations, we cover that in our course on depreciation. I call it Depreciation Made Easy. I love depreciation. It's my favorite thing to teach. Temporary reduction in employee paid payroll taxes and self-employment tax. Employees generally must pay a 6.2% Social Security tax on all wages earned up to $106,800 in 2011. And self-employed individuals pay a 12.4% Social Security self-employment tax on self-employment income up to that same threshold. For 2011, that Social Security rate drops by 2 percentage points, which means the maximum tax on the earnings up to that threshold is reduced to 4.2% on employee wages and 10.4% on net earnings from self-employment. This is a pretty significant difference. 2% may not seem like a big number, but when you go 2% times 40,000 or 2% times 100,000, that's a big number. So this is a significant savings. The Temporary Payroll Tax Cut Continuation Act of 2011, which was just passed last month, temporarily extends the 2% payroll tax cut for employees all the way through February 29 of 2012. And of course, there was all kinds of fighting about this between President Obama and the Republicans, and Obama finally won out and got it. So we have it through February 29, 2012. Business tax credits. A number of expiring tax credits have been extended under the Reed-McConnell Act, including the biodiesel and renewable diesel credit, the refined coal credit, the energy-efficient new homes credit, ethanol, energy-efficient appliances, alternative vehicle refueling property, the R&D credit, Indian employment credit, railroad track maintenance, I'm sure that's an exclusive group, mine rescue team training, employer wage credit for activated military reservists, and the new markets tax credit. So those are all credits that were supposed to expire that still exist, but they affect a very small number of filers. Now the next form I'm going to talk about is the General Business Credit Form 3800. It has been completely redesigned, and I can't give you a really in-depth lecture on Form 3800 because it's going to take me a lot more time to study it. But I will give you the highlights of what they've done. Firstly, the form has always been a multi-part form. 3 pages long is what I remember from 2010. But now they've rearranged all the pages. And on page 1, we now have a part 1 called Current Year Credit for Credits Not Allowed Against the Tentative Minimum Tax. What that means is you might be claiming a business credit, except wait, you can't claim it if you have to pay alternative minimum tax. And some credits are affected by that AMT rule and others are not. Then we have credits that were previously reported in Part 1 have now moved to Part 3. Passive activity limit and carryover amounts for all general business credits are now reported on the form. And a new Part 3 has been added to reflect all of the general business credits that are reported on Form 3800 and also to identify the type of credit being reported. In addition, if a credit is being reported from a pass-through entity, the employer identification number of the pass-through entity must be re-entered in Part 3. Well, this matters if you are preparing an individual tax return and that individual tax return has a business that is claiming a credit, or if that individual tax return is receiving a K-1 from a company that is claiming one of these credits. So Haflinger Inc., for example, that's a flow-through of the healthcare credit. That healthcare credit flows through to the personal return of the individual shareholder and is reported on Form 3800. And Form 3800 has to be attached to the individual return, and now it also needs to show the employer ID number for Haflinger Inc. There's a 5-year carryback of general business credits of eligible small businesses, and you're considered to be a small business if you grossed $50 million or less. And here is the new Form 3800. I've just drawn a yellow circle around what is different on the form over a year ago. And we get over to page 3, And you'll see that they have check boxes, and there's detailed instructions about what to do when you check a particular box. You'll also see that column B asks for the EIN of the flow-through entity, and then the credit amount entered next to it. And this page has a listing of all of the credits. Now, our school, Pacific Northwest Tax School, does conduct a class called Tax Credits for Business, and we go into 3,800 more depth in that. So if you are a business, a CPA or a tax preparer who deals a lot with business and wants to know more about 3,800, then that would be the course to take it. Today I'm just kind of skimming through it. So what are some of the other business-related provisions affecting 2010 through 2012 returns? Well, let's take a look at them. Firstly, we have extend the expanded exclusion for employer-provided educational assistance. This particular provision came in back in 2001. It's part of the Bush tax cuts. And what it did is it allows businesses to pay college costs for their employees. And that was set to expire, but it has been extended through 2012. So if you are a business and you want one of your employees to go get some college education, you can pay for that, and it's a tax-free fringe benefit for that worker. The next one is bonus depreciation. For the period of January 1, 2008 through December 31, 2009, businesses were allowed to take additional depreciation deductions equal to 50% of the cost of the depreciable property placed in service for those years. Under the Reed-McConnell Act, that has been expanded and extended beyond 2009. For investments placed in service after September 8, 2010 through December 31, 2011, the bill provides for 100% bonus depreciation. Now, when we do depreciation for a business, we have the ability to claim something called a Section 179 deduction where we fully write it off. These bonus depreciation provisions really at the individual level don't bring huge benefits because most individuals would never spend enough money on depreciable assets to exceed the limits allowed under Section 179. These bonus provisions really benefit businesses that are too big and earn too much money to be eligible for a Section 179 deduction. So bonus depreciation really kicks in and helps those. But on your tax software will always default to bonus. Because bonus is automatic. It's not something you elect to claim. It's something you have to elect out of claiming. And so your tax software will grab it. One of the disadvantages of your tax software grabbing bonus is that bonus may not be allowed on the state return, and so you'll see an addition going on the state return. So one of the things I watch for on my tax returns is that when I see a person has an asset, I ask them, do you want to maximize your deductions or do you want to minimize your deductions and save them for later years? And if the answer is, oh, I want to save them for later years, then I need to attach a statement to the return that says I elected out of bonus. If I allow my software to just grab bonus and claim it, unbeknownst to me, if I'm not paying attention, the software for the state may be adding it right back into income. Now, at the individual state level, I can't tell you, those of you who are attending my webinar from other states, whether or not you are going to have an addition in your state. I can tell you that both California and Oregon add it back in. So if two states add it back in, there's going to be other states out there that do as well. Now, Oregon has really changed things by saying we add it back in for 2010 and earlier years, but we're not going to add it back in for 2011. But that's for my Oregon students at my Oregon update. California, I know, is continuing to add it in, and at your individual state level, I'd be looking for that. Also, when it comes to the Section 179 deduction, the thresholds are increased to $500,000 and $2 million. What that means is you can claim a Section 179 deduction of up to $500,000, which is why you don't need bonus depreciation if you're a small business. On the flip side, or the phase-out side, if your business places more than $2 million worth of assets in service during the year that are eligible for the Section 179 deduction, then you're going to have a phase-out there as well. Again, those really affect businesses far larger than what most of us small tax service people deal with. Cell phones are no longer listed property. That was new for 2010. This is something that had been going on, yappity-yap with businesses in the IRS and the federal government for many, many years, and the IRS was already being pretty lenient about cell phones before this new rule was passed, but it became official in 2010 that cell phones are no longer listed property. That affects how they are reported on Form 4562 for depreciation, and it also affects record-keeping requirements. So what I have observed when it comes to cell phone usage when I'm in an audit with one of my clients, the auditor says to the client, how much did you spend on a cell phone? Maybe $1,200 for the year, and what percentage business use is that? And if my client says 80%, they take it. If my client says 100%, they're going to go, really? Nobody's cell phone is 100%. So if you come up with 80%, 70%, 50%, in the audits, the auditors that I've observed seem to take it verbatim based on what my client says, except they don't like 100%, and it's easy to understand why. Extension of the 15-year recovery period for certain real estate developments. What this is talking about is if you do a leasehold improvement. You are a business owner, you rent a building, you lease a building, and you make improvements to the building. Under prior depreciation rules, the depreciable life of those improvements is 39 years, even if you only have a 5-year lease. So you spend $100,000 getting your restaurant all set up and ready to go, and you have to depreciate those costs over 39 years. Well, this 15-year rule is temporary, and it has been temporary since, I think, 2004. It just keeps getting extended. And it has been extended through 2011. And what that means is if you made leasehold improvements to your business premises, you can treat those improvements as 15-year property and depreciate them over 15 years. The benefit of doing that over 15 years is that they're also eligible for bonus depreciation, and they're also eligible for the Section 179 deduction. So there's a big difference between being able to deduct 1/39th of the cost of an improvement every year for 39 years over let's do it all now here on my tax return this year at one time. So that's another provision that as of 2011 it is now expired unless our government does something in 2012 to extend it again. Extension of special rule for S corporations making charitable contributions of property. S corporation shareholders may take into account their pro rata share of charitable deductions even if the deductions would exceed the shareholders' adjusted basis in the corporation. District of Columbia Enterprise Zone, and there's also a temporary reduction in S corporation built-in gain recognition period. So we're at the top of the hour again. I would say it's time for another 10-minute break. And I do see some questions that were popping up while I was talking. Robert J. asked if I would have charged less than $3,052 to figure the credit for my client. We did put a hefty price tag on the cost of that particular form, yes. So I've had a number of questions coming up to me during the break on FATCA. And I've also had questions coming up on this 1099 miscellaneous reporting. And I just put a link here in the chat box on where you can go on the IRS's website for all of the information on who must file a 1099. And it's pages and pages and pages of information, enough to teach an entire class on. So I'll just leave it to you to go research that on your own to see if your client is the type of business that does need to file. Now, one of the provisions that had been passed into law at the end of 2010 and then was repealed was the requirement that landlords would have to 1099. But that was repealed. But it's not to say that no landlord is required to 1099. Certain types of landlords who are operating businesses would still need to 1099. Therefore, I don't want to answer that 1099 isn't required of a landlord, but it could be required of a landlord. So go read the instructions and narrow it down from there. So we're working on, we've kind of flashed our way through a whole bunch of business provisions, and I did go through them very quickly. If you want to know more about those types of things, more information is provided in the manual that you can read through on your own time. Also, we have a number of business classes that we teach, including sale of business assets, depreciation, like-kind exchanges, filing of S corporations and LLC returns. We cover all of that stuff in very much a lot of detail, and we don't have time for it today. But if you want to know more, I have classes already done on that. We're going to move on now to line 13 of the Form 1040, which is where we report capital gains. And this is the point where I've been promising you I was going to give you some more information on FATCA, because I have an illustration with it. And what's different for 2011 is that they've changed the Form 1099B, and because they've changed Form 1099B, they've also changed Schedule D, and they've added a new form for reporting capital gains. So our world has just been thrown topsy-turvy. Schedule D has looked the same for over 20 years, and now it's different. It's a lot different. It doesn't look anything like it used to look. And the rules for completing it are completely different than they ever were before. So that is why I have a very detailed illustration, because it took me, I had to create the illustration to even get it myself. So one of the things that I have to do as I approach tax season is I wait for IRS to publish its forms, I wait for it to publish the instructions for those forms, and then I say, okay, what would happen if I had a client that ... and I create a tax return for them? And that's what I'm going to be giving you today. So starting at the top, or actually at the bottom of page 53, under Section 1202, a non-corporate taxpayer may exclude 50% of the gain from the sale of certain small business stock acquired at original issue and held for more than 5 years. This is a pretty small group of individuals, but essentially what they're talking about is there's a small business that started up. It had an initial period of time where it was raising capital to launch, and you came along at that early phase. There's all kinds of tests that have to be made, but if you're one of those early contributors and that company takes off and you make a boatload of money so your stock just shoots up in value, there are rules that say you can sell that stock and exclude half the gain from taxation. For 2009 and part of 2010, that exclusion was increased to 75%. And for stock acquired after September 27, 2010 and before January 1, 2011, that exclusion increased to 100%. So if you do have a client that is a client who purchased that kind of small business stock, it could be that they could sell it and pay no tax on it. I've had one client in my entire career that had such a thing. They invested in some company called Wizards of the Coast, who created the Pokemon cards. So that was an ongoing thing for several years with that particular client, and that's how I learned about it. So you just never know, and I learned about it when I was like a third-year tax preparer, so we're not talking about, some of these things seem obscure, and you're going to go, oh, well, that kind of client would only ever walk into the office of KPMG, but in fact, they can walk into just your little office. You just never know what you're going to get sitting in front of you. Okay, also for 2010, and again for 2011, there are 2 reporting documents that are new. One of those is Form 3921, and it is issued by a corporation for which an employee has exercised stock options. Prior to this form, there was no reporting mechanism that went on when an employee exercised stock options other than payroll gross up if the stock option required payroll gross up. So there's different kinds of stock options, and I do talk about that in another course called Basis of Assets. But let's save it to say that some stock options were reported or are reported on a W-2 when they're exercised, and other times they're not. And in the situations where they're not reported on a W-2, maybe they weren't getting reported at all. Do you think that's possible? So anyway, IRS came out with this new Form 3921, and it follows stock options when they're exercised. Then we have Form 3922, and this one has more is broader in its scope, I guess you could say. And the reason for that is that incentive stock options are a relatively uncommon animal these days. They were super common in the 90s, but there's not so much in the world of stock options going on, except for certain individuals who may have owned them since the 90s, or maybe they're working in companies that still happen to be giving them out. But most companies are moving away from them. For example, Intel, who's a big Fortune 500 company here in Portland, was issuing stock options out the wazoo to just about every employee they had for many years, and they've moved away from that now. Now they're focusing more on RSUs, ESPPs, and other methodologies other than incentive stock options. But this ESPP, or Employee Stock Purchase Plan, is very common. And Walmart has it. So don't think that you're only going to be dealing with this on white-collar workers over at Intel type companies. You could have the teller at Walmart who is purchasing through an employee stock purchase plan at work. So if they come in with this document, what the document is telling you is that they purchased stock through an employee stock purchase plan, and they purchased that stock for less than its fair market value. And there are rules about what happens when they purchase it for less than its fair market value, and one of those is that there's a gross up that goes on their W-2. They have to pay tax on that difference. And it's tracking that amount of income that was reported and taxed that is important, because when employees sell their stock purchase plans, the question is, well, was the difference between what you paid for them and what they were worth at the time included in your wages? Question mark. And the answer is, what are you talking about? All right. So this document is here to help clarify that. And I started to see a few of them trickling in last tax season, and we're going to be seeing more and more of them. One of the good things about it is that these get filed with IRS. And situations where an employee purchases stock through an employee stock purchase plan, and they do so in 2008. And in 2013, they sell. What do you do? How do you figure out their cost basis and so forth? That's a whole other class. And because it would have been purchased in 2008, no 3922 would have been issued, and that's not going to be a resource available to you. But beginning in 2010, employers are supposed to be issuing these. And what that means is, if an employee purchased stock through an employee stock purchase plan in 2010 and then sells in 2015, this 3922 can be a resource that maybe that employee kept, or if they did not, you can request it from the IRS through their transcript service. So this is really good stuff, but the impact and how helpful it will be is going to be seen over time and not necessarily at the time you file the return this year. Okay, so let's talk about 1099-B, proceeds from broker and barter exchanges. A new law mandating basis reporting for publicly traded securities takes effect for tax year 2011. And this is because a Government Accountability Office study showed that 7 million taxpayers, more than 1/3 of those who sold securities, may have misreported capital gains and losses. And about half of them did so because they misreported their basis. So this form I just showed you right here is in an effort to help track basis. The 1099-B itself is also charged now with tracking basis, except it takes effect only for securities purchased in 2011 and later. So if the stock was purchased before 2011, the 1099-B is not required to track basis, and the company that, the financial institution that manages the stock portfolio is not required to track basis. Now what we're going to see is, of course, companies that have been tracking stock basis for a period of time may jump right on board and start reporting on 1099-B for many, many years going back, or it may be they don't want to risk that and they're only going to show stock purchased in 2011 or later. It's too early to know. These financial institutions are not going to get out these new types of 1099-Bs until late February. So we're teaching this class in early January. I have no idea what my clients are going to be bringing into me. I'm only speculating at this point what I think I'm going to see. So I made a problem based on what I think I'm going to see. And after the season is over, I'll create a new problem based on what I really did see. So let's take a look at what's different. Form 1099-B is revised for 2011. Space is now provided to report the following information that was not reportable in earlier years. Firstly, the date that the stock was originally acquired. Never had that on there before. Box B, cost or other basis of the securities that was sold. Cost basis on a 1099-B? Get out of here. Oh, but wait, if box 6 is checked, box 3 may be blank. Oh, I think we're going to see lots of blank box 3s. Box 5, wash sale disallowed. Get out of here. They're going to actually figure out that there's a wash sale. I won't have to do that manually anymore. But maybe not right away. Oh, well, no, that should be right away because wash sales are sale and buy within 30 days, right? So wash sale reporting should be instantaneous. Hot dog. Okay, box 6. If this box is checked, boxes 1B, 3, 5, and 8 may be blank. I think we're going to see lots of checked box 6s. So the reason box 6 would be checked is because the stock that was sold was a non-covered security. A non-covered security describes investments for which financial institutions are required to report, or pardon me, a covered security describes investments for which financial institutions are required to report realized gains and losses. These are individual stocks purchased after January 1, 2011, mutual funds shares purchased after January 1, 2012, and bond options and other securities purchased after January 1, 2013. So you can see there's a true phase-in going on here, and it's going to be 10, 15 years down the road before we really see these documents being accurate all the time. I would say for the next decade or more, I'm anticipating they'll be inaccurate a great deal of the time. So you're still going to be saying, okay, basis was reported, but was it the correct basis? Or was basis reported for some of the shares, but not all of the shares? There's a question in the classroom, does the basis include the fees? And the document itself, the 1099-B, tells you whether it includes the fees. Because it's got, if you look here at box 2, it says reported to IRS, either the sales price or the sales price less commissions and other fees. Okay, so if you want to know whether the fees are subtracted from the proceeds or included in the proceeds, you look to whether box 2 sales price was checked or box 2 sales price less commissions was checked. Box 8, type of gain or loss. A checkbox indicates if the gain is short-term or long-term, but again, the box may be blank if box 6 is checked. Now, just thinking ahead on this, I figured, you know, most of those brokerage firms would know if the stock was long-term, because obviously if they've had it in their accounts for 10 years, it's long-term, right? But they still may not know the actual acquisition date or the cost. So my thinking was, we may see box 8 checked more often, even though other stuff is left blank. On the other hand, they might leave them all blank. We'll just have to see. All right, so here's the new form I promised you. Because 1099-B now has information on it relating to cost basis, the IRS decided it needed a whole new form to deal with this. And it's called Form 8949, Sales and Other Dispositions of Capital Assets. To accommodate changes to reporting information shown on Form 1099-B, the IRS has introduced a new form for 2011 and future years. The sale of property can no longer be reported directly on Schedule D. Instead, sales are reported on the new Form 8949, Sales and Other Dispositions of Capital Assets. Use Form 8949 to report all sales and exchanges of capital assets, including stocks, bonds, etc., and real estate, except where those sales were reported on Form 4684, that would be the installment agreement form, 4797, sale of business assets, actually 6252 is installment sales, 4684, I think that's casualty loss, and 8824 is like-kind exchanges, and 6781, I don't remember what that is. Anyway, if the sale is reported on one of those forms, then you don't report it on 8949. Okay. Now, includes transactions on Form 8949 even if you did not receive a Form 1099-B or 1099-S for the transactions. Report short-term gains or losses on line 1. Report long-term gains or losses on line 3. Okay, so let's take a look at the form. Now, it's a full-page form. It's actually a 2-page form, and I've just cut out the top of it for you. You'll see a full picture of it a little bit later, but for now I just wanted to show you the top part because the top part is what we're interested in. And first off, I've highlighted here, we've got Part 1, short-term capital gains and losses, assets held 1 year or less. And then you'll see I've got this yellow circle around these check boxes. A, short-term transactions reported on Form 1099-B with basis reported to the IRS. Then we have box B, short-term transactions reported on Form 1099-B, but basis was not reported to IRS. And then we have box C, short-term transactions for which you cannot check box A or B. That would be because there was no 1099-B issued. Okay, so I've given some explanations of those boxes in writing, but I'm just going to flash through to Part 2. Part 2, long-term capital gains and losses for assets held more than 1 year. Check box A for long-term transactions reported on Form 1099-B with basis reported to the IRS. Box B, long-term transactions reported on Form 1099-B, but basis was not reported to the IRS. And C, long-term transactions for which you cannot check box A or B. Now, what happens if there's a basis reported in the 1099-A or the 1099-B form, so you check box A, but the basis is wrong? They have a system. Okay. Also, the IRS does say in the instructions for box A, if you got a 1099-B and there is an amount shown for cost basis and the basis is reported to the IRS, then you check box A. But if the statement gives a basis in box, or on the 1099-B it has a basis, but the IRS says they did not report the basis to the IRS, then you pretend that there's no basis on the form and you check box B. Okay, so it's possible that the IRS is predicting that financial institutions may put the basis on the form but decide not to report the basis to the IRS. So you've got to be looking for that. If the form has basis but the statement says it was not reported to the IRS, then you don't check box A, you check box B. Got it? Make sense? Okay. Now, get this. Check only one box B on each Form 8949. For example, if you check box A in Part 1 of one Form 8949, include on that page only short-term gains and losses from transactions your broker reported to you on a Form 1099-B that included cost basis. That was short-term. If you have another 1099-B that has cost basis and was long-term, that would go on Part 2 of the form. And if you have a third 1099-B that has no basis reporting, then you would need to do a whole separate form with box B checked. You don't want to be checking boxes A, B, and C on the same form. Make sense? Okay. Exception to reporting each transaction on a separate line of the form, because they do say here, let me get back up to the form. The form is a whole page with all these lines and for reporting all of your multiple sales on. They want each sale to be separately reported with the cost basis all in like we're used to seeing on Schedule D. And you're supposed to list them all that way. However, the IRS is saying you don't have to list them all on Form 8949 if you attach a statement in its place. And the statement, of course, has to contain all of the same information that would have been on the form if you'd actually filled out the form. And tax software typically fills out statements. The software I use is Drake software, and with Schedule D, it would fill out Schedule D until it ran out of lines, and then it would attach a statement and put nothing on the Schedule D except C statement. Well, the benefit of the 8949 is it has lots of lines, so I would expect tax software will probably fill out all of those lines before it needs to attach a statement, but we'll just have to see what our software really starts to do as the season goes on. Exception to reporting each transaction on a separate line. Instead of reporting each of your transactions on a separate line of Form 8949, you can report them on an attached statement containing all of the same information as 8949, which I've said. And in certain situations, if you bought and sold the same stock, you can use those words various. That's permissible. So you could lump multiple sales of the same stock into one transaction and write various. Canadian Registered Retirement Plan. If you are the beneficiary or annuitant of a Canadian Registered Retirement Plan, enter any amount from 8891 on line 10, on line 1 or line 3, whichever applies, of a Form 8949 that has box C checked up at the top. So this, if you have clients who are from Canada, they have retirement plans that they participate in, similar to our 401k plans here, except Canadian retirement plans are not necessarily exempt from U.S. tax. So they're tax deferred in Canada, but they're not tax deferred here, and so they're supposed to be reported unless the person makes an election not to report using Form 8891. That's a whole other class. Okay. Other gains and losses where the sales price or basis is not known. If you have another gain or loss for which you do not know the sales price or basis, such as a long-term capital gain from Form 8621, enter a description of the gain or loss in column A of a Form 8949 that has box C checked at the top. If you have a gain, enter it in column E. If you have a loss, enter it in column F. Complete any other columns that you can. So each of the columns, I'm not going to read them to you, but essentially they make sense. Column A, describe the property. That's usually the name of the stock or the ticker symbol for that stock. Column B is space for code. This is important. In order to explain any adjustment to gain or loss in column G, put the appropriate code in column B. Well, column G is if there's a difference. Let's say you have a 1099-B and it shows cost basis, but the cost basis is wrong. You make an adjustment for that in column G, and the IRS wants you to explain the difference in basis by putting a code in column B. So there's a whole page of codes that I have here for you. Column C, date acquired. That's pretty self-explanatory. When did you get it? If you inherited, enter inherited, and it's always long-term if it was inherited. If you sold a block of stock all at the same time, you can enter various. Column D is the date sold. Column E is the sales price, and the sales price should match what is on the 1099-B. If you enter a number that's different than what's on the 1099-B, that's typically a problem. If you enter a number that's less than what's on the 1099-B, your client's going to get a CP2000 letter saying, hey, the taxes were done wrong. So there should never be a number total on your reporting documents that you file with IRS as a part of a tax return that is less than the total sales shown on 1099-Bs. That's an automatic problem. Cost or other basis. In general, the cost or other basis is the cost of the property plus purchase commissions and improvements minus depreciation, amortization, and depletion. If you inherited the property, got it as a gift, or received it in a tax-free exchange or involuntary conversion, or in connection with a wash sale, you may not be able to use the actual cost as your basis. If you do not use the actual cost, attach an explanation. Okay, Form 1099-B. If the property you sold was a covered security, its basis should be shown in box 3 of the form. However, if the security was purchased before January of 2011, it doesn't have to be there and very likely won't be there. Column G, adjustments to the gain or loss. As I said, if the 1099-B does show a basis and that basis was reported to the IRS and it's wrong, you're going to enter the amount of that difference in column G as a plus or a minus number. And then in column B, you will enter a code to describe the reason for the difference, and the very first reason is the basis shown on the document is wrong, and that's a code B. And then there's a whole bunch of other reasons why the basis or why you might have an adjustment entered, and those are all separate codes that you can read through for your reading pleasure in your own time. Schedule D, capital gains and losses. The Schedule D has significantly changed for 2011, and many transactions that in previous years would have been reported on Schedule D must now be reported on Form 8949. Complete Form 8949 before you complete lines 1, 2, 3, 8, 9, or 10 of Schedule D. Use Form 8949 to report the sale or exchange of a capital asset not reported on another form or schedule. Gains from involuntary conversions other than from casualty or theft of capital assets that are not held for business or profit, and non-business bad debts. Continue to use Schedule D to figure the overall gain or loss from transactions reported on Form 8949, and to report a gain from Form 2439 or 6252 or Part 1 of Form 4797. And to report a gain or a loss from 4684, 6781, or 8824. And to report a gain or a loss from a partnership, S corporation, estate, or trust, because those would flow through to it. They themselves would be the ones charged with filing the Schedule 80, reporting out those individual transactions. You're just going to get the K1 showing what the net numbers are, and it will flow through to Schedule D. To report capital gain distributions not directly reported on 1040, line 13, or effectively connected with capital gain distributions. So if you have capital gain distributions from a mutual fund, those can go directly to the Schedule D, and they don't go on the other form first. And finally, to report a capital loss carryover from 2010 to 2011. So these items here in bullet form are the items that go directly on Schedule D. And here is the new Schedule D, and you can see we have Part 1 and Part 2. We're used to that. Part 1 is where we report short-term capital gains and losses, but you can see that it's now saying enter the totals from Part 1, Box A of Form 8941. Enter the totals from 8949 with Box B checked in Part 1. Enter the totals from 8949 with Box C checked in Part 1. And then we see the same instructions for Part 2, Box A, Part 2, Box B, and Part 2, Box C. So I promised you a comprehensive illustration. This illustration is one that I originally created for our basic tax course over 10 years ago. The character is named Jake Edwards, and over the years, Jake's tax returns just keep getting more complicated, and this is where he's sitting this year. The forms required to complete Jake's tax return are 1040, a Schedule A, a Schedule B, a Schedule D, multiple forms 8938, multiple forms 8949, and multiple forms TDF 9-22.1. Jake Edwards, born in '74, is married to Mary, and she is a homemaker. Jake is an engineer at Intel Chip Inc., and during the year he sold non-qualified stock options. The sale of the options was reported through UBS Financial Services, Jake's UBS Form 1099-B, and the UBS Intel Advice of Exercise and his W-2 are all attached. We're going to have to prepare a Schedule D with that information. Jake's inherited stock from his father, who was a resident of the United Kingdom. His stock remains invested in Barclays of London. The year-end value of the account was £100,000, and the maximum value of the account during the year was £125,000. Well, the US dollar UK pound sterling exchange rate was 0.6410, which means the maximum value of the account during the year was $195,008 US. The account issued £6,000 in qualified dividends. That converts to $9,630 US. He did not sell any shares during the year. Jake maintains a savings account with UK National Bank. The account generated $500 of interest income during the year, and the year-end balance and highest balance of the account was $15,000 US for the year. He paid $100 of foreign tax on his United Kingdom interest income. Mary received a 1099 INT from U.S. Bank reporting $1,500 of Box 1 ordinary interest income for the year. So that would be not reportable on the TD form or the FATCA form because 1099 INT came from an American bank. So her income's taxable just as his is taxable, but hers won't need that separate reporting requirement. The Edwards sold stock and property during the year in the following transactions. They sold some stock holdings through Smith Barney and Sterling. All sales are reported on Forms 1099-B, as I'm going to show you later. They also sold the Intel stock options that were acquired by Jake through his employee stock option plan. An advice of exercise notice issued by Intel is included along with a substitute 1099-B from USB. They also sold some vacant land, which was purchased back in 1997. It had an adjusted basis of $20,000 and was sold for $100,000. They have a long-term capital loss carry forward from 2010 in the amount of $5,000. And I had to throw in a couple of stock splits for you as well to contend with. I have it on good authority that the IRS does ask stock split questions on its tax preparer exam. Edwards' basis in their stock holdings was affected by these splits. Kroger stock had a 2-for-1 split on 2-1 of 10, and Nike had a 2-for-1 split on 8-9 of 11. I have next itemized listing of the Smith Barney account activity for Jake Edwards during the year. It shows that he had 3 sales through his Smith Barney account, and he had multiple purchases that went on over time. And purchases are relevant when they correspond to a sale. When they don't correspond to a sale, of course, you ignore them until the year where they have a sale of that particular stock. So I'm not going to have you read through these, but what you can see is we have trade dates, we have trade prices, we have the number of shares traded, and we have a broker fee. Now, one of the things I observed on the 1099-B for 2011 is it doesn't have anywhere to report the number of shares sold. And the 1099-B for 2012 has added boxes for that purpose. So I think the people at IRS who created the 1099-B later realized they'd left off rather important information. So again, I don't know what we're going to be getting from the brokerage houses. I have to assume they're still going to somehow try and tell us how many shares were sold, because if they don't, it creates a problem. But anyway, I decided to tell you the number of shares sold on the document just by putting it in the name or description line. There just doesn't seem to be any other place for it for this year. So the first 1099-B I have filled out for you shows the date of the sale. It shows the sales price, and it says sales price less commissions. All right. Box 6 is checked, and there's no basis reporting going on, but it was self-evident that it was long-term, and so I had Smith Barney check that box. Now, the box that's next to the form provides an explanation of how I went about figuring the cost basis and what line of the reporting forms that I've put the information onto. And I'm not going to read these to you, we just don't have time, but you can read through those on your own to see exactly how I did my calculations. But in the end, for this particular sale, we have a cost basis of $730. We have a sales price of $2,260, and it ultimately will carry to Form 8949, Part 2, that has Box B checked. So this is a long-term sale reported to the IRS, but no basis was reported. That means it goes on Form 8949 with Part 2, Box B checked. Oh, I have my second password of the day, folks. Hawaii. Hawaii. I was thinking Canada last night, and then I thought correspond to a sale. Of course, you ignore them until the year where they have a sale of that particular stock. So I'm not going to have you read through these, but what you can see is we have trade dates, we have trade prices, we have the number of shares traded in, we have a broker fee. Now, one of the things I observed on the 1099-B for 2011 is it doesn't have anywhere to report the number of shares sold. And the 1099-B for 2012 has added boxes for that purpose. So I think the people at IRS who created the 1099-B later realized they'd left off rather important information. So again, I don't know what we're going to be getting from the brokerage houses. I have to assume they're still going to somehow try and tell us how many shares were sold, because if they don't, it creates a problem. But anyway, I decided to tell you the number of shares sold on the document just by putting it in the name or description line. There just doesn't seem to be any other place for it for this year. So the first 1099-B I have filled out for you shows the date of the sale. It shows the sales price, and it says sales price less commissions. All right. Box 6 is checked, and there's no basis reporting going on, but it was self-evident that it was long-term, and so I had Smith Barney check that box. Now, the box that's next to the form provides an explanation of how I went about figuring the cost basis and what line of the reporting forms that I've put the information onto. And I'm not going to read these to you, we just don't have time, but you can read through those on your own to see exactly how I did my calculations. But in the end, for this particular sale, we have a cost basis of $730. We have a sales price of $2,260, and it ultimately will carry to Form 8949, Part 2, that has Box B checked. So this is a long-term sale reported to the IRS, but no basis was reported. That means it goes on Form 8949 with Part 2, Box B checked. Oh, I have my second password of the day, folks. Hawaii. Hawaii. I was thinking Canada last night, and then I thought, what's the opposite of Canada? Oh, Hawaii. All right. The next document we're looking at is another 1099-B, also that says Smith Barney. But look at this. Basis information is reported. So we have basis, cost basis of $27.95 reported, and we also have sales proceeds reported. And therefore, this is a short-term sale. So it's going to get reported on Part 1 of Form 8949 with Box A checked. The next 1099-B has a purchase or a sales price of $25.90. Box 6 is checked. There's no basis amount reported, but I've gone back to my client's records and determined that there is a cost basis for these shares of $25.20, and we're going to report this sale on Form 8949 in Part 2 with box B checked. Then we have the next transaction, which is $2,380. We only sold 3 stocks through Smith Barney, but I've been talking about those 3 for half an hour now, right? So this one is a $2,380 sale. This involved a 2-for-1 split. So we sold 50 shares, but if you go back to the original purchase, there were only 25 shares purchased. But there was a 2-for-1 split, so we ultimately sold 50, and that means we sold all the shares we had. And the cost basis in those shares was $1,770. And this sale is going to be reported on 8949 Part 2 with box B checked. Next we have a separate brokerage house, Sterling Investments. Sterling does not have its act together. It was trying to be helpful, so it didn't check box 6, and it did put the sales price in there, and it did put the cost basis, but it's wrong. But because the cost basis is reported, we are going to carry this to Part 2 of the Form 8949, and we're going to put it on the 8949 that has box A checked, because basis was reported. It was the wrong basis, but it was reported, so we're going to put it there. And because it's the wrong basis, we're going to have to enter a $1,000 negative adjustment in column G to make up the difference between what was reported and what is correct. And we're going to identify that with a code B because, well, the basis is wrong on the 1099B. Okay, now we all know that brokerage houses simply do not issue 1099Bs that look like this. This is the IRS's standardized format, but you won't see 1099Bs that come across your desk looking like this. At least I predict you won't. Because most brokerage houses issue something called a substitute 1099B. Now, I did make an effort over a week ago to contact a brokerage house and ask them if they could possibly give me a sample of what their substitute 1099B will look like, and they couldn't do that for me. So I won't know what a substitute 1099B looks like until the brokerage houses start issuing them, and they have not started issuing them yet. So I looked at old substitute 1099Bs and imagined what a new substitute 1099B might look like, because I think that you need to be looking for this kind of reporting instead. So this is the 1099B that has been issued with respect to the exercise and sale of the stock options. And you'll see that we're saying the IRS box that is being reported is box 2A, and we have gross proceeds less commissions from a sale of $13,115. And then we have an amount entered on box 3, cost or other basis of $13,120.65. And then it says federal income tax withheld, nothing. Box 6, I just typed out, not checked. All right, and then short-term gain or loss, box checked. Okay, so you could get a statement that basically says everything on this page falls into these categories and then have them all listed underneath it. I would expect that brokerage houses are now going to be issuing documents that sort stock according to the box checking categories they fall into. That's what I think or predict that they might do for us. All right, so we're going to take this information and transfer it over to Jake's tax return. Now, because he sold stock options, Jake also received a Form 3921. And you can see the Form 3921 shows the number of shares that were transferred and the fair market value of those shares. He also has a W-2, and because these were non-qualified stock options, there's a code V on his W-2 showing a gross up of $3,621. So this $3,621 adds to his cost. And Intel very nicely issued him an advice of exercise notice that shows to him the number of shares that he bought, the sales price of those shares, the proceeds from those shares, and the total gain. And you'll see that the gain is $3,620, but that $3,620 was added to his W-2, so it means he's already paid tax on it, which means it adds to his basis. So ultimately, when you go back up to this 1099B or substitute 1099B, you'll see that his cost basis is actually more than his sales proceeds. And that's completely normal. When I see stock options, as often as not, the sales price is less than the cost. And the reason is that the broker fee adds to the cost and is held out, and their net proceeds are less than their cost, usually to the tune of $50 or so. Okay, and here is their finished tax return. So Jake and Mary Edwards are filing a Form 1040. His W-2 is reporting $128,621 of wages. They have a total of $2,000 of interest income, and I'll show you their Schedule B in a moment. They also have $9,630 of qualified dividends coming from that Barclays of London account. They have $77,999 of capital gains being reported on line 13, and I'm going to show you how we calculated that number. Tax return on the front of it, there's not that many lines filled out. It's not looking too complicated right here. Okay, now it turns out that there's enough withholding going on Jake's W-2 that he gets to itemize his deductions, not by much. They're just barely more than the standard deduction, $20 above the standard deduction, but that was just the way the math worked. And you can see I threw the foreign tax credit on line 47. And here is the Schedule A showing $11,620 of itemized deductions. And to keep this return as simple as possible, I gave you no other deductions to itemize. And here is the Schedule B, where we list the financial institutions that paid interest to the Edwards. The first one is the UK National Bank, that bank in England that paid $500 of interest. And then we also have US Bank, which issued a 1099 to Mary for $1,500. So the total interest reported on the form is $2,000. Then we have the dividend income that came out of Barclays, $9,630. Now at the bottom of the form, Part 3 is not new, but Part 3 looks new. So for a number of years now, the IRS has had check boxes at the bottom of Part 3, and there's a checkbox that say, do you have interest in a foreign bank account? Yes or no. Do you have interest in a trust that has control over a foreign bank account? Yes or no. And you're supposed to answer those questions. Well, this year, they've added a question. It says, at any time during 2011, did you have financial interest in or signature or authority over a financial account, such as a bank account, securities account, or brokerage account located in a foreign country? Yes or no. Then it says, if yes, you are required to file TDF 90.22.1 to report financial interest or signature authority, da-da-da-da-da-da-da. And then it says B, if you are required to file the FBAR form, enter the name of the foreign country where the financial account is located. And then it says, during 2011, did you receive a distribution from or were you the grantor or transfer to a foreign trust? Yes or no? So really, really what's going on here is this focusing in on trying to find this money hidden overseas and giving taxpayers and tax preparers every possible opportunity to come up with the correct information and voluntarily report it. And over time, the longer you go with failure to report, with all of these reminders staring at you in the face, the harder it's going to be to claim ignorance. All right, here is the Schedule D. And you can see that the Schedule D has income reported on lines 1, 2, 8, 9, and 10, which means we have to have 5 separate forms 8949 completed. 5. I do not need to attach a Form 8949 with box C checked for short term. I didn't have that many stock sales, right? I only had like 6 or something, but I managed to work it out that I would have to file that many forms. And then, of course, we have the short-term carry forward, or pardon me, the long-term loss carry forward from 2010 is appearing on line 14. So all of these numbers that you see in these columns coincide to numbers appearing on each of the forms 8949 with the appropriate box checked. These totals carry down and arrive at that net capital gain or loss for the year that carries over to the schedule or to the 1040 and is entered on line 13. All right, here is the first Form 8949 completed. This is the short-term form with box A checked. And I had 2 stocks that were reported in this part. The Intel shares, which were correctly reported, and the 50 shares of IBM that were also Looks like correctly reported. Yeah, those are fine. Then we move on to page 2 of form with box A long-term checked. And in this case, we have a sale where basis was reported, but the basis was wrong. So you can see I've entered the amounts that appeared on the 1099-B, $5,000 sale price, $3,000 cost basis. But I've entered a negative $1,000 in column G because cost basis is actually $1,000 higher than $3,000. So it reduces the gain. And then we have, the description is that this particular stock was inherited. Okay, then we move on to the next 8949, and we've got box B checked for short term, and we had one sale transaction reported on this page. We move on to page 2 of this form 8949, and we see that we've now checked long-term box B, and we reported 2 sales. So two stocks were sold long-term and reported to the IRS without basis. And that's why we've checked box B. And the final sale is the land. No 1099-B was issued on the land, and the land was held long-term. So the land is reported on part 2 with box C checked, and it's a single transaction. And all of these numbers get totaled at the bottom of the form. And you can see here I've said box C long-term totals are shown on line 4 of form 8949 right here. The net gain is $80,000, but it doesn't show $80,000 as the gain. That gain actually gets calculated on the Schedule D. Okay, but we show the cost of 100, the cost of 20, and the sales price of 100. And I know mentally 80 is going to end up somewhere on the Schedule D, but we don't calculate the 80 here. So let's just go back up to the Schedule D real quick to see what happened. That's on page 74. So we go on to Schedule D and look at line 10, because that is where the 8949 long-term with box C is carrying to. And there we see the 100,000 sales price, the $20,000 cost, and the net gain of 80. Okay, so that's the Schedule D. And now we have to file the 8938 form, and we have 2 separate accounts where we need to file that form. One is the Barclays of London account, and the other is the UK National Bank account. Both of the accounts are in Jake's name only, but the form up at the top here asks what is the name shown on the return. Even though it's Jake's account, it's a joint return, so Mary's name appears on here as well. And then it asks what kind of return was filed, what is the year in question. It asks the type of account, the account number, the maximum value of the account during the year, $195,008, the foreign currency or exchange rate that was used, and the name of the foreign currency, which is pound sterling, the name of the financial institution, the address of the financial institution. Okay, and then we go over onto page 2, and on page 2, we've done reporting for the income generated off of these foreign accounts. So we had $500 of interest income that was reported on Form 1040 line 8A and was also reported on line 1 of Schedule B. And then we had $9,630 of dividend income that was reported on 1040 line 9A and 9B as well. And it was carried to Schedule B line 5, or carried from Schedule B line 5. 8938, the second one we're looking at is for the UK National Bank. And this was a much smaller amount of money, only $15,000, but because the total of all financial accounts is more than 150, all financial accounts have to get reported. So we have all of the same type of account information for the UK National Bank. Then we move over to the TDF 90-22.1 form, or FBAR, FBAR. They've got report on the end. All right. And in this one, this has only got Jake's name on it. The reason it only has Jake's name on it is that when it comes to this particular report, it doesn't go with the tax return. So they're not asking what name appears on the tax return. They're asking whose report is this? And you're required to file the report if you have ownership or control over a foreign financial account and the total value of your financial accounts that are foreign is $10,000 or more at the high point during the year. And that's Jake. And Mary does not have ownership of any of these accounts, so she does not file the form. Now, if Mary did have ownership of any of these accounts, and she independently has ownership of accounts that also are at $10,000 or more during the year, she also would have to file her own FBAR reports, even when the accounts are joint. So you can have a situation where Jake could have his own foreign account in his own name, and Mary has her own account in her own name, and then they also have a joint account. And each of them would file an FBAR report showing their singly owned account plus their jointly owned account. And so that jointly owned account might even be reported twice. That's possible. So here's the one for UK National Bank. And then on page 2, we've listed Barclays of London. So the final worksheet that you'll see in this illustration is on page 86 of your manual, and it is not a form that gets filed with the tax return, but it is the form that is used to calculate the amount of tax to enter on the Form 1040 form. So I threw it in there for your reading pleasure. All right, so we are exactly at noon, and that tells me it's time for lunch. And the beauty of lunch is you have an hour for lunch, and you can use lunch to study Jake Edwards. And if after lunch and studying Jake Edwards you have any questions for me about Jake, I'd be only too happy to answer them for you. Oh, I forgot to give you the joke. You guys, if you happen to notice at the bottom of every form, including the new forms, there's the Paperwork Reduction Act notice. Okay, yeah. Is it fully engaged?